I pulled out my copy of New Trader, Rich Trader. This is one of my favorite books ever for traders. If you don't have a copy, go on Amazon. It might be $10, right? It's going to be one of the best $10 you ever spend. I know I always tell you that whenever I recommend a book, but you've got to get this book here. Now, one thing that I wanted to do was the very first time I read this was on Kindle. And I don't like ebooks, but I did read this one on Kindle. And I went back and I'm like, hey, look at that. I can access this on the computer. And it shows all the parts that I highlighted. So I was like, this is perfect. This will go back into Chris from ages ago, giving his opinion versus Chris now when he's got more wrinkles and less hair. Peter says, bought last week. It's great. Oh yeah, very cool. Brian says, come on, Chris, you couldn't be wrong about the market post-election 2 times. Bro, listen. Michael says, it's a great book. Brian, I will not make the same mistakes again. That's for sure. And one thing I'm not going to do is trade around it. So I'm going to sit on sides. Just what I'm going to do. Michael says, it's a great book. Randy says, I'll only do strangles on earnings, but the premiums are outrageous at times. Yeah, I gave that up as well. But you know what? I'm not going to give up teaching you guys how to make awesomeness in your trading account. So let's do this. For teacher mode, you really need to wear a turtleneck with your blazer. Well, maybe I will tomorrow, Brian. We'll see. So this is chapter 1 in the psychology section. These chapters are quick. I'm only going to hit the highlights here. And I just really want to give you my perspective, having been on both sides of New Trader and Rich Trader here, as to how this looks to me today, right? And how I have learned from A to B, right? So new traders are greedy and have unrealistic expectations. Rich traders are realistic about their returns. Boy, I tell you, that really hit me when I was reading through this, because if you remember just a couple days ago, we had someone in the Discord say that Chris's trades are just not good enough. He doesn't have enough returns on everything. And you know what? That's okay. If you have those expectations of having 100, 200, 1,000% returns on every trade you put on, by all means, dude, you do you. I'm going to continue doing me because it's working out pretty well, right? Now that we've locked down the, in fact, go back to this. Now that we've locked down the master key and we are trading less, but trading better, master key results for the year are currently at 108%. So this is what I'm looking at for next year. 108%, 81% win rates, right? And yeah, that's getting those measly 2 to 11% wins over and over and over again. But new traders are greedy and have unrealistic expectations. Rich traders are realistic about their returns. I don't know why I highlighted he was ready. New trader projected that he could double his account in a few months, then double it again. That is not very realistic, right? Even with everything all set up that way. If you plan to trade huge, you can make huge returns. But keep in mind, right? It's like swinging for home runs. You're going to hit some home runs, no doubt about it. But you're also going to strike out a lot. And the question is, can you afford those strikeouts, right? If you are coming up to bat and you're getting 1 out of 3 right, but that 1 is worth, round numbers here, that 1 is worth $100, and you're so stoked about it. And the other 3 that you put on each lost you $100 because you're swinging for the fences here, right? It's not going to work. No. Many have blown up their accounts, some losing 50% or more of their starting capital. Others have gone bankrupt when they didn't control their risk or ignored their trading plan. Well, look at that. Isn't that what I talk about all the time? Controlling your risk, position sizing, and having a trading plan. You know, I say that because it's the truth. Having a plan is what separates the best from the rest, right? And it's pretty cool that I highlighted that 100 years ago when I did. Randy says, base hit trades are more profitable than the occasional home run. Yeah, for sure. All right, let's go on here. To reach his initial goal, he would need to find a stock that would double quickly. Wow. Dude, I would love to find a stock that would double. When's the last time you found a stock that double quickly? Daggum. Even with all the outlier data out there, pretty sure it's not that easy to just find a stock that's just going to double quickly, right? Everyone has a plan until they lose all their money, and then they realize how crap their plan was. uh, Over here it says that hot stock you're in love with could just as easily fall 50% instead of doubling in price. And that reminded me of something in Discord a couple days ago. I think it was Max. Max and I were talking a couple things. Let me see if I can find it. Hang on. Here we go. Max was talking about position sizing and how he didn't realize just important that was, right? Like with BX, how I traded at 8 times less in size than OHI. And he didn't understand, at the time, he does now, how important it is for that position sizing. And so this position sizing has a big impact, bigger than anything. Yeah. So Max said, therefore, it might not be profitable. And you must understand that by having a limited portfolio size, each one could have an outsized impact, positive or negative, until it can handle the risk more easily. So if you're trading with a smaller account, you're not going to be able to put on 10 lots or whatever, right? You might have to be limited to 1 or 2 contracts per. Now, that 1 or 2 contract per is going to have an outsized impact on your small portfolio. And that makes total sense, right? You're putting a larger portion into it than you would if you had a different sized account. And he's saying, therefore, it might not be profitable to do that. And I said, yeah, or it could be incredibly profitable, right? You put on a 1 lot and, it takes up your entire account and then it doubles. Well, daggum, that's an incredibly wildly profitable trade. But they don't always work right like that, right? But it absolutely can happen. And that's where I was going with that is that stock that you love could as easily fall 50% or double in price. You don't really know. And because of that, you've got to position size correctly. In addition to all those factors, the market would need to trend. In addition to all these factors, the market would need to trend in favor of your trading style for you to make those type of returns. Wow. How about that? You always start with the market. Let the market tell you which way it's going. Oh my gosh. I can't tell you how long it took me to understand that sentence right there. I'll never forget the time where I was at the public library with my son. He was little, it's probably 3. And I had my phone up and I was looking at QQQ and at the people who I was learning to trade from at the time. So stupid now. They were like, hey, listen, when the market's going up, bro, you sell calls as the market's going up. Now, you at this point in your life in 2024 are probably thinking, why in God's green earth would I sell calls when the market's going up? Wouldn't that be the world's worst trade in the world? The world's worst trade in the world. Yes, it was. From the moment that I put that trade on, it lost money until I took it off. The moment I put it on, I'm telling you, 3 seconds after I put on that trade, it was a loser until it was just like, what a stupid trade, weeks later, and I had to take it off. And all I had to do was go in the direction of the market, go in the trend. But no, I thought it was smart enough. I followed these people who thought they were geniuses. They're like, oh yeah, just when the market's going up, sell calls. It comes back down. The market comes back down, and then you make all this money. Duh. They were huge believers of the efficient market theory. I am here to tell you right now, the efficient market theory has been debunked, right? The efficient market theory would say the SPY cannot trend like this. The efficient market theory says that there is absolutely no chance that could happen. Well, maybe not no chance, but a very, very slim chance. Whereas trend traders are like, well, yeah, it's trending. Efficient market theorists think that there is no trend. That is a very stupid way to trade. Let's go on. No, you want to get rich slowly. Nobody wants to get rich slowly. But if you're trying to get rich fast, you're going to take risks that are too big. Right? You're going to take, isn't that what I want to do? Win big? No, you want to get rich slowly. You want to make consistent returns over a long period of time. You can grow your account rapidly by compounding your gains. Kind of like what Randy was talking about, right? I just closed that spreadsheet. Let me open it back up. Is this boring to you or is this useful? Because this is my jam. I can talk about this all day. I love trading. Like I have trading running through my blood. right? All of these are very minor returns, right? Average win 17%, average loss 15%. Nothing huge is going on here, but the win rate being 81% is very consistent, right? And so you see right here in this, what is that called? Normal distribution chart, right? Most of them are within this one standard distribution, which is 67% or 64% of the time, right? A lot of them are just flirting with zero. It's only these outsized ones that really make a difference out here, right? Now, there's more outsized ones out here than there are out here. I don't even know why we have any over here. Those are the losses. But you can see here, right? A 14% month is pretty damn awesome. And then you add a 12% month on top of that, which that's what that looks like, right? A 14% month plus a 12% month plus a 30% month, ciao, plus a 7% month, plus another 7% month, right? Right there and right there. Right? You don't need huge wins. What you need is not big losses. That's it. That's it. Tug says it's useful. Very cool. Michael says very useful. Wes says useful, not boring at all. Oh, appreciate it, dude. Ryan says turtle versus the hare. Gotcha. Peter says, does the percentage also count if you just do stocks instead of options? It would be much smaller. Much smaller. I mean, there might be a 1 or 2%, might be a 1 or 2% move in the stock, yet a 17% move on the option, right? Now, you could go out of the money options and you might see voluminously bigger percentage changes, right? You might, where my option may only go up, if I'm doing an 80 delta and it goes up by 10%, right? Your option at the 20 delta, so 4 times less, might go up 40%. Does that make sense, right? Because we're talking deltas here. And I'm only buying the deep in the money options, but you might be buying the out of the money options. You might be buying 4 times as many. So your trade might go up 40%, and mine might only go up 10, but yet we're going to end up at the same place. All right, let's go back to here. Successful trading is based on ever increasing account equity and minimum drawdowns. Now, this is something I learned from Minervini, the minimum drawdowns, because he showed me his results one year, somewhat like this, right? And what blew my mind was how little he lost. He didn't have giant months, right? He had months, kind of like this, but it blew my mind because it's like, wait a minute, you don't have to have big losing months. You don't have to have big losing trades. He's like, no, dude, when you avoid those big losers and you just stack winners and even just stack tiny losses, that's the way it works. That's the way this game is played. And so when I saw his returns just like this, over the course of a year, he had several months he didn't trade, several months where he did trade. I don't remember if he had any losing months. And if he did, it was less than a couple percent. But it was like, whoa, I don't need giant months. I 6% month, a 7% month, and you compound that, turns into giant returns overall. Realistically, a good trader can get 10 to 25% returns per year. Some great traders can produce 50%. And if they have outlier, good gravy. This is going to be awesome, by the way. You need to focus on a sound strategy, system, and trading plan, and not profits. How many times have I said that, right? Focus on your entries, focus on your exits, right? The profits will fall out, right? Having a good plan, having an edge in the market, not automatically, but in theory, given enough trades, will drop out profits. Good trading will create your profits, but focusing on your profits will usually lead to bad trading, which is one of the reasons why I tell people, turn off your P&L. In your broker, go turn off your P&L. You don't want to be jaded by that. I don't even know how much I've made or lost on a trade until I've closed the trade. I don't even know on the percent, right? You see me, I have to go calculate my percent on each one because I don't want to know. I want to focus on execution. Because when you add in the emotional factor of, oh my God, I just lost enough to buy my Tesla. Or, oh, dude, I just paid off my Tesla today, right? You don't want to think in those terms. You want to just focus on execution. Ahesh says 6% is actually huge per month over the long term. I know, dude. Ahesh, we're gonna change finance, dude. Let's go on here. People who look for easy money invariably play. That was me. People who look for easy money invariably pay for the privilege of proving conclusively that it cannot be found on this earth. Yeah, I'll never forget literally praying in church. Please, dear Lord Jesus, let this trade work out. And it didn't. But that's okay. It's because it didn't that I learned some really great lessons that I can pass on to you today. And then this will be the last bit for this chapter. My study of profitable professional traders and money managers leads me to believe that these are the high end of the average annual returns that are. Wait a minute. Rich trader step. My study of profitable professional traders and money managers leads me to believe that these are the high end of average annual returns that a successful trader can expect. Achieving this kind of result requires a proven strategy and is followed with discipline. Followed with discipline sounds exactly like somebody who I wish I had the opportunity to be mentored by, but unfortunately I wasn't. Richard Dennis. I always say you could publish rules in the newspaper and nobody would follow them. The key is consistency and discipline, which most people don't have, right? If you're going to show up, if you're going to do this job, I mean, consider it a job, right? You're going to show up every day to do this job. The job is to take care of your family. That is your job here. So you need to show up to do it, or just don't plan on getting paid. How's that sound? However, I do want to continue on working on New Trader, Rich Trader, right? This is a little series that we're going to be putting together. I think I'll probably make a long video out of this and then title it New Trader, Rich Trader. I don't know, something like that. I don't do the editing. I just do the talking. So this is one of my all-time favorite books. If I could give you a list of 5 books to pick, this would be on that list. In fact, let me go ahead and give you that list of 5 books. As you know, I sit at home in my library with a green screen behind me. I have probably 1,000 books in here, maybe more. I am a bibliophile. That's the word. I'll give you my 5 favorite books. So, Complete Turtle Trader, got to get that one. $10. All of these are around $10. New Trader, Rich Trader. This trend following, not this trend following. By the way, I've had a chance to talk with Michael Covell, and personally, I feel like this book is not as good as this book. This book was the best $9.99 I ever spent my entire life. This is the, I'll tell you which edition it is. I believe it's 2004 edition. Yeah. If you can find the 2004 edition, these are textbooks, by the way, for trading. If you can find the 2004 edition, significantly better than the 2017 edition, just saying. So that's 3. So you got those, then Trading in the Zone, which we covered the other day with Mark Douglas. We went into a long episode with him. Let me see what else. If I had to pick of my books, what would it be? Oh, this is tough. Okay, I'll give it 6. How I Made $2 Million in the Stock Market by Nicholas Darvis. Also co-written by Steve Burns. Steve Burns, who wrote New Trader, Rich Trader. And then this one here, Market Wizards. This gives you... oh, I just turned to Minervini on that particular page. This, in my opinion, is one of those books where it's like, oh, you really can do it, right? And Minervini is a great reference point as well, because he came from, I wouldn't say poverty, but I would definitely say lower middle class. And I mean, dude's like wealthy beyond belief. But yeah, those would be the books I would pick up. Give me a second here while I put everything back. And then I teleport back to the Outlier Global Head. 3, 2, 1. There we go. Look at that. Just in the instant. But yeah, this one here. Yeah. So this is one of the things I'm talking about with Minervini. Great dude, like crazy sweet dude. But he says in here, one of the keys to his success is no vacations, 6-day work weeks, and 14-hour work days. His reply was, my desire to be the best trader is greater than my desire to take a break. I don't like to get out of the swing. Listen, I can't imagine that being my lifestyle. That sounds pretty miserable, honestly. But like I say, dude loves staring at charts. That's his jam. Just not my jam. I would rather let technology do it for me, and I just click and go. Right. Michael says that's awesome. Dave says congratulations. Michael says it's divergence, like Pam-Ella. Whatever, dude. I live in Texas. I can say divergence, whatever I want. Thanks for the help this week, Dave. Yes, Dave has been awesome. All right, so getting back over to new trader, rich trader. Click the buttons here. Go to this one. Okay, let's do this. So we're on chapter 2. New traders make wrong decisions because of stress. Rich traders can manage stress. Now, I've said this before, but the best way to manage stress is position sizing, right? When you position size in a way that you've already built in volatility, which we do every day, right? I've even made a spreadsheet for you, so it's super simple. When you position size based on volatility, you're not buying 100 of the same thing, right? You're not buying 100 shares or 100 contracts or 100 anything of Coke. You're not buying 100 contracts of Coke and 100 contracts of Tesla and expecting the same outcome. No, because you're taking significantly more risk with Tesla. Tesla moves a lot more than Coke does. But when you position size correctly, you can say, okay, I only want to risk 5% of my account. And I might have to trade 5 contracts of Tesla and 60 contracts of Coke to get the same percentage of risk. When you do that, you don't stress, right? I know I've locked in this much risk to my portfolio. And hopefully it works out. But if it doesn't, it's not a big deal, right? When you position size correctly, trading doesn't become stressful at all. I mean, it can be fun and it can be frustrating, but it doesn't become like, oh no, those moments, right? We've all had those. I remember putting my son to bed one night, coming out of his room, and I was like, oh my God, if the market crashes tomorrow, I'm so freaking screwed, right? Nobody wants those. Nobody wants those moments. And then the book goes on to say, this was entirely different from paper trading and simulations, right? Everybody knows how to paper trade, but once they start trading for real, all those plans get thrown right out the window. This was real money, his money. Every cent came from his blood, sweat, and tears. And to have 250 bucks, give me a break, to have 250 bucks snatched away like that felt like he had been robbed. Felt like he had been robbed. I bet Tesla shorts are feeling pretty robbed right now. Hang on, where'd it go? Why wasn't it going the way he planned? The pressure, the stress, the fear he was feeling was much worse than he had anticipated, especially for such a small drop in price. Most stress comes from unknown variables or uncontrolled emotions, fear of loss, uncertainty of the market trend, or the need to make money. Sometimes the trader's ego gets wrapped up in a trade with their self-worth tied to whether or not they make money. Dude, it's funny that I highlighted that years ago because, I mean, just like everyone else, right? I've had losing trades, and I would really tie up my personal net worth, my self-value, and what balance I had in my trading account, right? If I was doing well, if I saw another zero in my account, I'm like, oh, dude, I'm such a genius. I'm so smart. I'm so handsome. My wife loves me so much, right? All these great things. But if I'm losing, it's like, oh, just utter depression. It's like, how could I have done this? Why did you do this? I don't know how many times I said to myself, how could you do this again, Chris? I don't know how many times I said that to myself. So you've really got to separate, and this is why I mentioned yesterday, turning off the P&L, right? Just focusing on the execution. And you know when you're winning and you know when you're losing, right? But turning off the P&L, focusing on, is this going the way I want? Sweet. I'm going to let it run until I get my exit signal. Is this going the way I want? No. Well, do I have an exit signal? Not yet, but I'm getting close. And once you get that exit signal, just go, right? But I can't stress enough the fact that it's all about position sizing. You fix your position sizing, you fix your trading. It's just the truth. Before you place a trade, you need to have an exit strategy of how, when, and why you will take profits and what your stop loss will be. Kind of sounds like what we do every single day, right? It's so much, and that's one of the reasons why I go through so much time to go through these trades, right? Let's talk about BX. right? BX was a loser the other day, whatever, right? I had my exit strategy. I have my exit strategy written the frick down, right? You can't tell me that I didn't follow my strategy when I'm looking at it and I'm looking at the stock and I'm like, okay, let's just see what happens. And then it closes right above your half ATR. You're obligated at that point to keep the trade. That's something Larry Height talked to me about. So one of the original market wizards, first $1 billion hedge fund manager, he was like, listen, if you've set up your trade and if everything sets up and you don't take it, you have invalidated your trading model. Everything that you've been working on is moot point, because it doesn't matter if you can't execute the plan. And the same is true if you don't take it off, right? If you're scared to lose and you don't take it off, it's like everything you've done, set up your plan for this exact moment. And then if you don't execute it to close or to open or whatever, just throw it out the window. It means nothing. So that's one of the really important things as a trader. And that's why I say it separates the best from the rest, is having that exit strategy as well as the entry strategy. You have to plan to sell your stock at a specific percentage loss, price support breach, or trend change, right? All of which we include. If your stress level is high after you have a trading plan, then you're either trading too big or you don't have faith in your system. If you know your system is a winner over time, then try cutting your position size in half. And if trading 1,000 shares stresses you out, try trading 500, right? If it's stressing you out, try cutting it down in half. My position size right now is 7%. It's honestly one of the biggest I've ever had, if not the biggest. But if I was stressed out by it, I would cut it down. I would cut it down to 5. And if that was still not working for me, I would cut it down even more. Right. And if your account's not big enough to have those sizes of positions on, that's okay. But you guys got to, I mean, if you can only afford one contract, I get this. I totally get this. We've all been there. I was there. Don't think I wasn't. If you can only afford one contract, each contract is that much more important, right? So those are the ones where you want to make sure the losers are as small as you can, right? May even take smaller risk. If you can only afford one contract, you don't want to put all of your eggs in the one basket and just set that basket on fire, right? You want to make sure you're taking as little losses as possible and letting those winners run as far as they can. So I need to make sure that I have a system to follow, design a trading plan that I'm comfortable with trading, and I need to test my system to make sure it's a winner. This is also one of the reasons why I'm so data-driven, right? Why I went over the last 2 years of data, not just in my trading, but trying to like optimize where that would be. And, now I have data to back up that I've got, 81% win rate when the master key is working. Over 2 years of data, I found this. So I'm like, freaking, I want an entire year of trading to make that happen. But it was along the losers that taught me a lot of those issues, right? In fact, Leo Wargs was the one who pointed out, hey, why don't you take a look at market breadth? That was the very last key in the master key, the last part of the master key. That made all the difference. So you need to design a trading plan that you're comfortable with, test your system to make sure it's a winner. So I'll have faith in your strategy. And if I still feel too much pressure, I can decrease my trading size until I'm comfortable. Yes, exactly. You need to have a plan to control your outcome of the things you can't control, like having a stop loss, right? Control the things you can't control, like having a stop loss. There's two ways to look at this. Having a stop loss on your trade, right? Having a stop loss on your trade and also position sizing correctly puts a stop on your portfolio risk, and it puts a stop on this on the stock risk, right? Because if you only put in 10% of your account, whatever, you can only lose maximum 10% of your account. That is a stop loss to your account. But if you put a 10%, my math is going to be way off. But let's say you put in a stop on this particular stock to only go down 10%, then that's 10% of 10%, which makes 1%. Then you have a strategy that's going to work. Then you have a strategy that'll last. Trailing stops, position sizing, timing, technical indicators. You need to be comfortable with the volatility of the stock you're trading. Traders need a trading style that's compatible with their personality. If you're stressed out of your mind, then your lack of faith in your system or lack of confidence or abilities. Sorry. If you're stressed out of your mind, then your lack of faith in your system or your lack of confidence in your knowledge or abilities are likely the cause. Alternatively, your position size may be too large for your peace of mind. If you experience high levels of stress during trading, either your position size is too large or you don't have enough confidence in your system. To reduce stress, lower your positions, or do more testing on your system. Trading stress is typically caused by one of two things. I bet you can guess what it is. Not knowing what to do or knowing what to do and being too afraid to do it. It's kind of like what I was talking about, right? Where if everything sets up and you don't take your plan, you have invalidated your model. Only risk 1% of your total trading capital per trade using stop losses. Well, clearly, I do a little bit more than that. Using stop losses and proper position sizing. Proper position sizing limits the emotional impact of a single trade. That's what I'm talking about, right? You've got to limit your position sizing so you limit the emotional aspect of it, right? Each trade is only the next one of 100. If you keep this in mind, you will give a completely different trading perspective. And remember, if you don't know what to do, don't do anything. If you don't know what to do, don't trade. That's okay too. Sitting on the sidelines, what we're doing like right now, is a very viable trade. Brent says, depends on your goals. He could have had worse habits. Yeah, he could have had worse habits. I did want to continue working on New Trader, Rich Trader, right? This is, in my opinion, one of the top 5 books that you should have as a trader. It might cost you $10. You can get it on Audible. You can get it on Kindle. You can get a paper copy, whatever. The first time I have it on all 3. In fact, I have it on Kindle, paperback, and Audible. And the first time that I went through it, it was on Kindle, and I went through and I highlighted all my notes from that. So we're on chapter 3 right now. Chapter 3 is new traders are impatient and look for constant action. Rich traders are patient and wait for entry and exit signals. I can always tell. This is so easy to tell. When somebody is new to trading and they come in the Discord and they're like, oh, I want to take this and that. Oh, what do you think about this and that? Oh, let's do this, right? And it's like, hold your horses. I can tell you're probably new to this. Just because there's things to do doesn't mean you should do them. In fact, one of my other top 5 trading books is Trading in the Zone. And that's what Mark Douglas says in there. He's like, his quote is something like, there are unlimited possibilities of things you could do in the market because nobody's sitting there tell you you should or shouldn't do anything. That gives you the opportunity to do anything you want. But that doesn't mean you should, right? So new traders are impatient and look for constant action. Rich traders are patient and wait for entry and exit signals. The best example I ever had of that is I was on a business trip and I had my iPad and I got in the back of an Uber and I'm driving down the road and I don't remember the circumstance, but I had almost a full boat of nothing on in my portfolio, right? Maybe 1 or 2 positions. And I'm like, well, I got nothing else to do. I got all this cash on. Let me go ahead and put some trades on. So I'm in the back of an Uber, selling put spreads on everything, right? Not looking at chart, not making a plan, not knowing where I'm going to get in or out. And by the time I got out of the Uber, I was completely in, right? The whole portfolio was in. And I even remember showing my wife, I was like, look at all these trades I got on. Like, wow, aren't I a genius? And it's like, I didn't really have a plan on those. I was just thinking, hey, I got money to burn. Let's go burn some. And I probably burnt way more than I should have in that process. So while a new trader was watching this particular trade happening, he started to question himself. What was he doing? Hey, he had no exit strategy. He had no idea why he had just bought those shares. You ever been in that circumstance? Have you ever put on a trade and you're like, I have no idea why I bought this? Especially when it's not working. I don't know why in the world I did that. This is not working out great. Did you even have an exit strategy when you bought those shares? It's super common, right? Don't feel bad about it. He didn't realize at the time, but greed was his motivator. And in the future, it was going to ask him to make some bad decisions. Maybe trying to create a trading plan during trading hours wasn't the best idea. And so that, we go through my particular trading plan every day, and I like to preface it and say, this is my style of trading, right? Because it may not be for you, right? You might be the kind of person that wants to buy tons of out of the money options because you like the idea of the options going up 200, 300, 400%, right? I'm content with it going up 10, 20%, maybe 30, 40%, right? And you're probably thinking to yourself, but Chris, why would you do that, right? You got to get those out of the money options. Well, no, right? It's a different style of trading, right? The YOLO options are not for me. The YOLO options are not for pro investors. The YOLO options are there so that people who are impatient and novices can give their money to the more patient and more skilled traders, right? What is it? There's old traders and bold traders, but you never see old bold traders. That's the old adage. What causes overtrading or spontaneous trading? Rich trader paused and reflected before replying. Well, it can be a number of things, including not having a solid trading plan, getting impatient, looking for excitement, or being arrogant and thinking that you're smarter than other traders. Right? Not having a solid trading plan, getting impatient. Oh, I think impatience is the hardest skill to master as a trader. I mean, consider it this way, right? Imagine that you are becoming a downhill skier, right? You have to have patience for snow. You can't, well, there's probably like roller blades or something you could put on, but you can't go downhill ski until you have snow. So it's like you can't put on trades until you've got your setup, right? Consider it that, right? You've got ideas in place, you've got time, but you don't have to do anything. So many people who get into this sector, this job, if you want to call it that, and they want instant action. They want to be doing something every single day because they feel that if they as a trader are not trading, then they are therefore not a trader. I couldn't disagree more. As you can see, I will sit on the sidelines for weeks. One of my very favorite quotes, and I can't remember who said it. It's one of the market wizards. He says, "I wait for my trades to set up to where it's as easy as picking, candy off the floor in the corner, right? Or shooting fish in a barrel, if you want to consider it that way, where it's like you just have to sit and wait and not do anything until it sets up, and then once it sets up, then you can go. But in the meantime, just hang out. There's no reason to be impatient." I would suggest that you only trade money. I would suggest you only trade only to make money. Let me read that one more time. I would suggest that you trade only to make money, not for entertainment or to prove something to yourself. Profitable trading is often boring. Said that many times. Good trading is really boring. If you already know what you're going to do before you trade, it takes a lot of excitement out of it. If you have a trading plan and a good system in place, there are no spontaneous trades. This is Chris in a nutshell. You will spend your time waiting for entry signals and exit signals. You will learn that your system makes you money in the long term, but your ego loses you money in the short term. Trade your system and not your opinions. I'm going to read that one more time because this is me in a nutshell, right? If you already know what you're going to do before you trade, it takes a lot of the excitement out of it. If you have a trading plan with a good system in place, there are no spontaneous trades. You will spend your time waiting for entry signals and exit signals. You will learn that your system makes you money in the long term, but your ego loses you money in the short term. Trade your system and not your opinions. That was a popular point that was highlighted on there, apparently. Do your planning and research while the market is closed. Trade your system when the market is open. It's better to do nothing than to do what is wrong. For whatever you do it to yourself. That's a quote from Buddha. Oh, that gives me a little goosebumps there. Randy says, out of the money trades or lottery trades. Michael says, I like Wes's idea. Take that downtime to study. Yeah, that's what we're doing, right? I want to give you the best experience possible, which is why when we have downtime, let's study, let's read up, let's plan. Peter says, trade in an impulse trade, nice chart, but after buy, I saw a 22K volume. I don't know if that was good or bad. 22K volume on like the shares is probably really bad. Objective traders have a quantified method, system, rules, and principles that they use to trade. They get in a trade based on facts, and they get out where there is based on price action. Objective traders have a written trading plan to guide them. They use objective historical price action charts, probabilities, risk management, and their edge and outlier. They react to what is happening only if it can be quantified. No hunches here. No feelings. They go with the flow of price action and not the flow of their emotions. Don't attach your ego to trades. Be the trader that witnesses the trade from an emotional distance with respect and curiosity. If you can put some space between yourself and the trade, you'll become more accurate and more profitable. Yeah. This is a really good chapter. So this was chapter 3, right? Yeah. We'll be covering chapter 4 tomorrow. But I want to make sure, like we're talking about here, right? We are always giving you the best content possible. And right now, while I'm not trading, I want to make sure I can teach you as much as I can. So Peter says that was definitely bad. Let's take a look at new trader, rich trader. So I wanted to take this time while I am not trading and to give you the best content possible out there. So one of the things that I'm going to be doing is going through several of my trading books, talking about some of the great lessons that I've learned from them. Right now, we're working on new trader, rich trader, and we're currently on chapter 4. Hey, Brian had a great idea. Free Teslas. Woo! That sounds almost as good and almost as feasible as giving every new home buyer $25,000 and all the other stuff that Kamala promises. So yeah, great idea, Brian. Thanks for funding that. Okay. So chapter 4, new traders trade because they're influenced by their own greed and fear. Rich traders use a trading plan. Rich traders use a trading plan. Oh wait, there we go. Rich traders use a trading plan, right? I mean, it took me years to come up with this, and it does evolve. It absolutely does evolve, because when you are a trader, something's going to come up and you're going to be like, oh, hadn't seen that before. And so you need to make some rules. Like, for example, trading into earnings, right? At one point in time, I wouldn't care about trading into earnings. I'd be like, yeah, of course I'm going to trade into earnings. But now it's like, well, do I have reasons to hold it into earnings, right? Is it already profitable? Does it break my expected trend line? If it's not going to have any of those issues there, if it's already profitable and not going to break my trend line, then yeah, let's hold through earnings. So there's always a malleable aspect to a trading plan, but only not in a way it's like I'm going to break my rules, but in a way of like, oh, I need to make sure that when this happens again, I have a rule in case. Wes, trying to squeeze it in between my 9 to 5 soccer practices and more. Sounds like excuses, Wes. Give me a break. I'm just giving you a hard time. So it's kind of a weekend project, but hopefully I'll get some stuff posted as I go. And I'm finding it interesting. Wes, I think you and I are very kindred spirits, dude, because I can look at data like this all day, every day. And I just enjoy data diving like that. Brian, you don't have the power of taxation. Well, hopefully Kamala won't either. All right. So let's go to the next step here. He decided to risk only 2% of his account per trade. This would significantly reduce the risk of ruin he had read about so often. If he traded a $5,000 position, he'd only be risking $200 of his trading capital. With a 500 share position, that'd be 40 cents a share. His stop on his trade would be about $8.95 since he bought at $9.35 and still had 500 shares. So, different, more leveraged way to promote position size is actually a note that I had written down. This is one thing that I learned directly from Steve, the author of New Trader, Rich Traders. He's like, listen, when you put on a 10% position in your account, right? It's not 10% of your account. If you had $100,000, you're not taking 10,000 and putting it into one trade, right? That's not 10%. In fact, it's way less, because you don't intend to hold that to zero, do you? Or do you? If you're trading to zero, I can't help you there. But if you're only going to trade with like 1% of that coming down, or 1% working against you, right? That 10% of your account and only a 1% stop loss in this case, you can trade significantly larger than 10% of your account. I mean, you may even be able to trade 30, 40%. If you're only giving it a 1% stop loss, but you're saying, I want to put on risk on 10% of my account, you can do a really big position. In fact, let me run my data real quick. So right now I'm at a 7% position. Where that came from is honestly because like this is killing it. And I feel very comfortable with the 7% position. But most of my trades fall, and you can go through the Discord and find this too. But most of my trades are falling in the 2-ish%, 2 to 4, 5%, really 2 to 4.5, almost 5. We'll call it. In fact, why don't I just do the average here real quick? Hang on. Average account impact is 2.05%. So I'm trading with a 7% position size and risk, But at the end of the day, my average risks to the trade, gain or loss, it's only 2%, right? Kind of what he's talking about there. But my actual position size is way bigger, right? Some of these I'm putting on between 10%, 15%, 20% of my account, right? So I can't put on a whole bunch of trades, but I'm also keeping my risk in check on these, right? So my actual trading dollars, I'm talking between 10 and 20%. Risk to the account on average, positive or negative, is around 2%, right? So I'm taking, let's use round numbers, 20%, putting it in, winning or losing about 2% of the account means, it's 10% of the actual risk that I'm putting on. Michael had a question. I'm curious. Where others are with position sizing, I won't risk more than 1% on a single trade. That's what I'm willing to lose. I like to be no more than 5% of my account into a single trade. You know what? That's a great question. All right, let's continue on here. Would he give up and go back to working the job for the rest of his life? Or would he follow the path to wealth as a trader? In fact, Michael, just thinking about that, I think the more confident you get with this, in fact, Randy was talking about this not that long ago, because he was going from 1%, I believe, up to 5%. The more confident you get with trading, the bigger you can trade because you understand what you're going to do no matter what, right? Would he give up and go back to working at a job for the rest of his life, or would he follow the path to wealth as a trader? When he put it like that, the choice seemed simple. He would be a trader. What other job offered this kind of opportunity, freedom, and these odds of success? It's like a lottery he could win based on his hard work and discipline. I feel like that could have struck out of the book here. Reason being is that so many people come into trading thinking it is a lottery, right? So many people come into trading, especially around the meme stocks and how those exploded, right? They come into trading, they're like, I saw this not long ago. Lambos or food stamps. Really? That's how we trade? Lambos or food stamps? No. We're not going to have like 2% moves in the account. No. That's stupid. Lambos, food stamps, nothing in between. Okay. Hope it works out. Probably going to be several Lambos, food stamps, or just food stamps forever, and you never actually achieve the Lambo. But yeah, no thanks. Pride is a great banana peel, as are hope, fear, and greed. The biggest slip-ups occurred shortly after I got emotionally involved with positions. That comes from Ed Sakota. Ed Sakota is one of my, unfortunately, I have not had the opportunity to be mentored by him. I don't even know if he's still alive. But Ed Sakota is one of the original market wizards and one of my trading heroes as well. I learned of Ed Sakota from Steve. And he's kind of my role model with trading because he comes in and now this is ages ago. I'm sure it's changed. But he comes in, he runs his programs, and then he's done trading about 10 minutes because he knows what he's going to do, right? I mean, if he has a signal, he's going to execute. If he doesn't have a signal, he has everything else in the world to do instead. That's the way trading should be, right? Come in, check your signals. If you don't have anything, move up. And that's what Ed Sakota is known for. Successful traders have a plan for success. By carefully putting the odds in their favor, successful traders will overtake gamblers who rely on random trades and prayers. How many times have you relied on that, right? Oh man, I mentioned this story the other day when I was in church, saying, "Please, Lord Jesus, don't let me lose this trade." Which, of course, I can, ended up losing like the entire trade, Lambos or food stamps at that point. If you want to win in life, you must study, work hard, and be disciplined. That's what we do every day, right? There are no shortcuts, especially not in trading. You need to enter the markets well prepared with a detailed trading plan and weather the storm. Let's see if there's anything else on the next page. No. So at the end of the day, many like food stamps. Not me. At the end of the day, the point of this chapter here is, do you have a trading plan? I have a trading plan, and that's what I show every single day. But do you, right? Is your trading plan the same as mine? If it is, what happens if I'm not around, right? What happens if you take a trade? If it your trading plan, what happens if you take a trade and maybe I'm on vacation? Are you going to know what to do? right? It's great to be able to do this one-to-many coaching like we do every single day. It honestly is great. And I know that this makes a huge impact. But are you ready to take this on your own? I'm not saying you should. I'm not saying, the time is now. You need to go off on your own, right? I plan to do this as long as I physically can. In fact, my son asked me one day, he said, Dad, how long do you plan on trading? And I was like, as long as I'm still breathing. Like, I don't ever plan to stop, ever. This is my favorite game in the world. And unlike the NFL, right? I'm not going to age out at 24. I'm not going to, hit the wall at 32, right? I can continue to do this literally as long as the computer's plugged into the internet. I can continue to do this because we are going to be taking over the world as outliers. This is one of my all-time top 5 trading books right here. And I managed to find my Kindle version of it. I have it on Kindle, audiobook, and physical book as well. That's how much I enjoy this book. But in chapter 5, we're going to go through all of the notes that I highlighted to myself the first time I read this ages ago. And if you're actually interested, I did interview Steve Burns, the author of this. You could type in my name. You could type in Christopher Ewell, New Trader, Rich Trader, and you'll see me interviewing Steve right there. Little baby face me. Like, look at this. Look at this.
An easier way,
Oh
I
my
guess you could
gosh.
say,
Look at this guy.
to profit
He's
in
that dude.
whatever market. I mean, you want to be a part of the trend, right?
Look at
You
this
want
guy.
to be jumping.
That was 60 pounds ago, by the way. So yeah, and I'm just like a little baby there. This was 5 years ago. Hard to believe, 5 years ago. So anyway, back to this. Chapter 5. New traders are unsuccessful when they stop learning. Rich traders never stop learning about the market. That's what I was talking about just a couple days ago. While I do have a trading plan, there's always things that happen, right? And you may not know, you may not have a plan for that. And in the moment, you've got to act in the best way that you think you can, which in my opinion is always reducing risk. But then you need to add that as a new rule. For example, trading around earnings. This was something that I needed to learn by trading with earnings. Day trading order blocks, right? I don't day trade really ever. But if a stock is coming up into an order block, what do? Do I just let it do its thing? Well, maybe. Or if it does something else, I need to be reactionary as well. So a trading plan is always going to evolve. And I think that that's what he's trying to say here. Rich traders never stop learning about the market because there's always something that can come up and be like, I've seen this before. I know what to do. Brian says, trading election night. You want to. Everyone else is doing it. All the cool kids are doing it. I know, Brian. Brian is in a swing state. And I am not here in Texas. Thank goodness I live in Texas by the grace of God. But I haven't seen any of the ads, but I was listening to a podcast this morning and somebody was talking about how they were in a swing state. And it's just like incessant ads. So curious to see how that's going over there, Brian. So let's go back to this. It may work well for a while, then suddenly stop working and give your capital a large drawdown. Hang on, let's back up real quick. Let me back up a little bit. Okay, it says, I have this trading thing figured out, New Trader said. Rich Trader spit out his orange juice. New Trader said, what's so funny? I'm sorry, Rich Trader said. I just don't think I've ever heard anyone say that before. I've done lots of research and I decided on my trading style. Trend trading. I like that. I've also written my trading plan. He handed Rich Trader a piece of paper. And Rich Trader said, this is a great start. Start, New Trader said incredulously. This is like you're turning in your first freshman paper. If you're like other successful traders, you will have to test this system first and then make adjustments. Here we go. Now that we've had the context, it may work well for a while, then suddenly stop working and give your capital a large drawdown due to a change in market conditions. The system may not even work. You don't know yet. Or it might make you a nice profit in a bull market and then take the profits back in a bear market. If you want to be profitable in a bear market, you may have to reverse your system and sell the same stock short when they break down through support. Testing your system and back tests in real time will teach you a lot. First, you need to get an idea of what your winning percent and average size of your wins and losses, right? So figuring out your trading plan and then having some data around that. Record breaches of discipline and why you traded off your plan, right? You must always be watchful of an inflated ego taking over trading and be on the lookout for greed and fear. Boredom can turn good traders into bad traders. Yeah. Boredom can turn good traders into bad traders. Boredom, having that money in the bank and being like, I got nothing else to do. Let's buy some stock. It's not a great idea because they look for action instead of following a process, right? You're never going to see me take what is what I'm thinking of? Just an off the wall trade, right? If it doesn't fit my trading criteria, I don't even look at it. I'm not even looking at the market right now. There's no need to. An impulsive trade. A trading journal is like having a teacher who teaches traders about themselves. Now, this is really cool too, because this is how we figured out the master key, having that trading journal. Because when I was going through these trades earlier this year, hang on, pull up some data here for you. When I was going through these trades earlier this year, the second half of last year, and those of you who have been with me since last year, remember, we had it a crazy second half of last year. We were up 44% in the second half of last year, and it was awesome, which is somewhat like what we're seeing right here. And I got to thinking, why am I having this losing streak over here? I got the outlier data in my hands. I'm following the trend of the market. What is going on? So I went through line by line, and I'm like, well, this didn't work, or this did work. What are the commonalities between the things that did and didn't work, right? You have to think of like a detective, right? Think like a detective. Be like, if this worked and this didn't work, what was similar and what was different? And a lot of the times the differences are outside market forces, which is what the case was here. And then having ideas, testing those ideas, reviewing your data and saying, you know what? When I add in not just market breadth, which I definitely need to add in, but when I add in sector breadth, my portfolio went from looking like this to looking like this. Come on, load. Dramatic effect is not there when I asked to load. There we go. Went from looking like this to looking like this. And I think, I sure am glad that I had my trading journal. Right? It's just a spreadsheet. And you can get access to this exact spreadsheet in the Discord. Go over to the VIP Investors Toolkit. Scroll up a little bit to High Performance Portfolio Manager. That's this. That is this, right? If I hadn't had this information, I would not have figured out, with the help of you guys, what we were missing to make the master key. So I was super stoked about that. Let's catch up on the chat. Brian, Georgia has fewer commercials than North Carolina. They should turn this into a movie. Dude, I think they will turn this into a movie for sure. Dave says, I have a reading journal that I created to be available on Amazon in the next couple of days. Already been using it. You have a reading journal that you created that will be available on Amazon in the next couple of days. Okay, cool. Already been using it a while and testing it works great. Maybe he meant trading journal. Either way. Mahesh, 2016 is when I got involved in building algos for stock markets. Early models were simply taking open, high, low, closed data and running a deep learning model. And I thought I figured it all out. Then over years, I realized how much of a constant learning we need to build something solid. I totally agree with constant learning. Yeah, for sure. Trading journal. Hey, everybody, whenever this is available, Dave, share the link and we'll all go buy one. Okay, so let's go back over here. A trading journal is like having a teacher who teaches you about themselves, right? In addition to your technical trading information, be sure you note your mood, your feelings, and goals. Include your charts and buy and sell areas marked as often as possible. Listen, I don't do that. I don't put in my mood, my feelings, or my goals. Not at all. What did I write on here? Great idea. I wrote to myself, great idea. Include your charts with buy and sell areas marked as often as possible. I do put on there, what day I bought it, what price I bought it at, what price the option was, what price the stock was, all that information. Because I do think that that's useful. And of course it's useful because it will tell you what's working and what's not. Always stay humble. Always know the market is too big for anyone to master. You must never stop learning about yourself, about the market, and about risk. Oh, this also here. How many trading books have you read? 10. Most of the best traders have read hundreds. How long do you spend looking at charts each day? A few minutes, right? Speaking of books, right? Hang on. We're going to go from the jungle and we're going to teleport to my library. Whoa. All of this, and all of this over here. These 4 shelves are all trading books. Now, I will tell you, the very first trading book I ever wrote was, what was it called? It's about option spreads. She Can Trade. Hang on, I'm gonna find it. She Can Trade. Sarah Potter. Amazon. This book was the worst book I ever read. And to be very honest, I wish I had never read it. Now, that's a really strong negative endorsement. I'll agree. But it was so bad that I put down trading books for 2 years because this was the first trading book I picked up. How you can trade like a pro? Yeah, I want to trade like a pro. And I read it. It was hot, awful. And probably read it around 2014, which is when the publishing date was. And I literally put trading books down for 2 years because of this. And it wasn't until talking to Steve, he's like, read this book, read that book, Chris, like when he was teaching me. And I'm like, oh, okay. There actually are some really great trading books out there. So yeah, please don't ever read this book. Dave says, trying to watch and listen, driving down the road. And he will. Already shared some copies with Mahesh. Very cool. Awesome. All right, let's get back over to this. Always stay humble. Already talked about that. Great traders spend hours a day doing homework on backtesting, chart studies, identifying support, resistance, and trends. Great traders are lifelong learners. My advice is to always be a student of the market and always go to bed each night understanding more than you did when you woke up. With hard work, experience, and focus, you will one day convert all of that time into money. I can tell you that for dang sure. Trading systems are built for an individual's risk tolerance and personality, which is why I say it's my style of trading in the trading room here. I'm going to give you some help. I'm going to give you assistance, but it may not fit for you. But the principles used to build trading systems are basically the same. You must choose your system that will be profitable with a high win rate, a high win rate, or big wins and small losses. And you must eliminate the possibility of large losses in your trading system. You must eliminate the possibility of large losses. My average loss is 15%, which sounds huge. But when you see my average win is 17%, so it's greater than that, and I win 81% of the time with the master key, give me a break. And you have to eliminate large losses, and you do that by position sizing, okay? Sometimes you can't help when the stock drops, right? You can't help that. But you can keep your portfolio from getting wrecked by position sizing correctly. By implementing risk management tools of stop losses, option contracts, futures contracts, and position sizing. Nathan, where have you been? Good to see you. Michael says, are you new, trader? The inspiration to Burns to write this book? Now, it was already written before me, but man, Steve taught me so much. I am eternally grateful for Steve. I certainly had a lot of those moments, and I'm sure he got really tired of me asking the same questions as new trader when he and I started working together. Tug says, I am so happy that we have so many experienced, intelligent, and analytical traders in this group. I agree. Dude, like, I think it's only a matter of time before this YouTube channel just blows up, turns into like bigger than Benzinga, bigger than any other trading channel out there, because we provide so much value here. Even in the jungle, we provide so much value. With Outlier, we provide so much value. It's only a matter of time, right? All we have to do is be consistent with consistency and discipline. So that's going to wrap it for me today. I hope this was helpful. I hope this was useful. If you haven't already got a copy of New Trader, Rich Trader, go put it in your Amazon Christmas list for your wife or a significant other to get for you. It's probably like $7. Definitely worth the $7. It's also a great read on Audible. You'll find a lot of my trading style in this book here. You know what, Michael? There is like a second edition or an updated edition. There may have been some inspiration from me in this. But yeah, Steve is a great guy. This is a fantastic book. We are on chapter 6 at this point, I think. Oh, are we on part 2 risk? Hang on. Chapter 5. Yeah. We're in chapter 6, part 2 of risk. Hey, Mikey Mike just got his New Trader, Rich Trader book today. Very cool. It's a really good book. And also, Mikey Mike, I would suggest grabbing it on Audible. Listen to it while you're driving around. It's really good. The narrator did an incredible job. New traders act like gamblers. Rich traders operate like business people. Right? Let's see what else I highlighted here. Cutting losses was crucial. Many of the stocks he sold with his $250 loss continued to fall, and he would have lost over $1,000 on one of them. He needed to know the amount of money he was willing to risk before he placed the trade, which is why, man, this is really cool to me, right? This is really cool to me going through this, listening to Steve's words of wisdoms, and then pointing out where it fits in with our trading plan, which is why he has to establish his risk before he places a trade. How do we do that? Right? Position sizing, right? Position sizing, and then knowing on the chart if things go wrong, right? Having your exit rules. By doing that, you're setting yourself up for success twice. The trade may not work out, but you're not going to blow up your portfolio if you manage your risk correctly. He shook his head and looked down at his desk. He needed to stay on track. It would be foolish of him to buy a stock with no plan. I want to know, what's the last stock you bought with no plan? Let me know in the chat. Just type in the name of the stock or maybe what the catalyst was that caused you to buy that stock. I want to know, what stock did you buy without a plan? Oh, Michael says the Audible version is good. Both books. Yeah. Oh, there is New Trader, Rich Trader too. You're right. Let me know the last stock you bought without a plan. It's been so long because for me, I don't even look at the market. I'm not looking at a name. I'm not looking at anything unless I have a plan. I think the one that probably comes to mind for me was AMC, right? During the meme stock craze in 2021. And I went on TV. I was on Yahoo Finance like right after that, talking about how much fun it was because this is my world. I've been doing this for ages. And people came into my world and they're like, let's go. I want to play the game too. And it was so much fun for that window of time. And AMC actually fit all my risk profiles, but I didn't trade it. Well, I did trade it, but it wasn't on my radar because it was like $4 at the time. I ended up doubling my money and got out, but it was so much fun during that time. And the only reason I got in was it came to my attention from all the news. I looked at my trading plan and I'm like, it actually fits everything. It's just lower price than I normally do. I'll give it a shot. So that was pretty fun. Peter says, DJT was an impulse and he lost. Oh man. DJT. That's the Donald John Trump stock. Oh dude, Peter, if you right, and that's the other thing, right? You always kick yourself and say, if I had only held it. If I had only held it. But who could imagine it going down like that and then immediately popping back up? By the way, order block city, right? Came down, up into the order block, rejected. Came near that order block, rejected. Into the order block, rejected again. The order blocks are crazy. Look at this order block out here. I don't remember what's going on back there, but either way, the first time you see it come into there, rejected. Legit. Mike says Apple. Remember Apple a few years ago was like the stock. In fact, let's go to the weeklies. Or the monthlies. Apple was, this is what I remember. This is exactly what I remember. Apple was the one stock that you could just buy and forget about, and it goes up. I don't know if that's still the case, right? Because there's definitely some pullbacks and such, but Apple's, past performance is not indicative of future results, but Apple has been a monster. Michael says ASTS. Whoa. Did you do well on that, Michael? Because that one was a huge one. ASTS. What a rip. Woof. Order block. Another order block. That was cool. Michael says he got super lucky, almost 300% lucky. Oh man, that's my kind of lucky right there. Peter says it was a Halloween massacre that happened to Donald J. Trump stock. All right, let's go back over here. When New Trader showed up around noon, it occurred to him that he never saw Rich Trader watching financial news. Huh. Kind of like me. Nor did Rich Trader, I watch politics. That's what I watch. Nor did Rich Trader have fancy trading desks with multiple monitors. I actually have 3 monitors. I have 2 curved monitors here. I don't know. They're like 24 inches each. So I have like a full workspace. Some people have like a wall of monitors. Now I've got 2, right? And I go back and forth, right? I got StreamYard going on over here, and then the one you see every day is the other one. And then I have like a little cell phone sized monitor where I can put things that I want to monitor, right? Like I can put the market down there and just like let it be. Like imagine having your cell phone connected to your computer, a computer output. That's what I've got. And it's just like one of those I could just leave on and not bother with. But I get that, right? Some people love all the monitors. I don't. I just got my 2. I don't even consider the 3rd one. Just is down there. New Trader wondered if he was still actively trading. Oh, okay. New Trader wondered if he was still actively trading because he doesn't watch financial news, or if he had retired. Like all businesses and disciplines, the psychological aspect is usually the most difficult, said Rich Trader. Being a professional means doing your job no matter how you feel. A trader has 2 jobs. You're a researcher, right? You are a researcher, right? I consider it like a scientist. In fact, I did some back testing over the weekend. I just remembered I can show you. A trader has 2 jobs. You're a researcher and you're a trader. First, you must do your research. You need to find systems that have a good probability of success in the long term. Test those systems and create a trading plan that fits your personality. This is what I preach every day. Decide the correct amount of risk to take on for each trade based on your winning percent and historical drawdown. Then your job is to follow that plan and not change it during market hours, no matter how you feel. Don't change your plan during market hours for sure. Adjustments should only be made in off hours. So I mentioned some back testing I did. Let me show you what I did. Give me a second here. So Mahesh had asked me to do some back testing because we're changing up the overlays, and Mahesh has seen how well the 10, 20, 50 works in his own trading, his own observations of what we do. So he's adjusting the overlays inside of Outlier to, let me go to one so I can show you real quick. He's adjusting the overlays in Outlier to mimic that. They were based on an algorithm before, but he's like, wow, the 10, 20, 50 looks really good. And then he and Mark did a back test, and you're not going to believe this. Just buying and selling, okay? Just pure buying and selling when the overlay starts, when the overlay finishes, which is basically the 10, 20, 50 versus their uptrend algorithm. The 10, 20, 50 beat it by 30 percentage points. And I was like, let's go. This is what I've been trading with forever. In fact, I got it from New Trader Rich Trader, if you can believe that. Well, I'm sure we'll come across it at some point. I actually got it from New Trader Rich Trader. And Mahesh was so stoked when he saw that. But he said, in the shorts, it doesn't work. In fact, it is about 30 percentage points worse than the red overlays. And so they were like, Chris, we feel like the 10, 20, 50 is probably a great start to the overlay. But where is the exit point, right? If we're going to exit it early, where would that be? Not SPY. Where would that exit point be? And so what I did was I ran lots of data this weekend. I did it inside of TrendSpider, and it's really cool inside of TrendSpider. Let me show you what I did. You can go to Strategy Tester, and you can save all these strategies. You can see all the ones that I did, and you can click one of them, like 10, 20, 50 right there. And then all I did was change the exit criterias, and I hit run. Now, none of these are good. They're all losers in this case on the shorts. But what I found was in the Variance Explorer, this is such a cool thing here. Variance Explorer. And then you can change to whatever strategy you want. Daily, 7,000 candles in this case. That's the deepest I can do. But you can run it on all these different names all at once. And this is something we did a while ago, but I was really stoked when I found that, right? So, I mean, some of these it doesn't work all that great, and then some of these it does really great on, like 150%, 125%, 54%, and these are shorts. So what I did was I was like, okay, on a baseline, and so this is what you have to think about as a trader is like, okay, what variable would I change? So I was going through these, and I'm like, I could change to 520 or 10, 20, 50. So imagine that's our baseline. In fact, let me mark that gray as our baseline. What variable can I change? So I was changing the first moving average. I was changing the second moving average. I was changing what moving average, if it crosses over, I could get out at. And what I found was the 1520 cross back had the second highest returns in this case, but also the highest win rates. And I was like, it's 1 percentage point off here. So I was like, wow, that's really cool. Now you as a trader need to do these type of things. You need to find your data and you need to say, what can I do to make some improvements? Where can I go and make those changes off hours to find where I can make improvements? Right? Like it says right here is being a professional means doing your job. No. You're a researcher and a trader. First, you must do your research. You have to find systems that have a good probability of success long-term and test those systems. So I sent that data over to Mark and Mahesh, and we're still evaluating on the red overlays, what we're going to do. But that's part of the fun of being a trader, right? You get to discover something that maybe nobody else knows, like Outlier, right? You discovered Outlier. You were having incredible success with Outlier. And you did that by testing and seeing how it was working, right? And part of that testing was probably watching these YouTube videos and figuring out if it was going to work for you. The key to success is to lose small and win big. When you're in a loser, get out. The best trades make money at the buy point. When you're winning, let it run until it stops. You will lose if you don't cut your losses. This is something that I have also really taken account with, is that the best trades make money right at the buy point, right at the time you're getting in. And that's what we see with Outlier, right? Is the trades are either going to work right away or they're going to flounder, or occasionally they just don't work out and you get out really fast, right? You don't sit and wait and hope that it comes back. There is also one more very important thing Rich Trader added after a moment. When you go to your computer to trade, you should approach it as if you're entering an auction, not a casino. You should feel like you're going to work for your own business, not like you're playing the slot machine or spinning a roulette wheel. If you experience these feelings, or if you just want to gamble, you're going to eventually fail as a trader. Trend traders make money, chart readers make money, swing traders make money, day traders make money, and position traders make money. But all gamblers in the market eventually lose everything. I thought that was solid. Michael was talking about his ASTS huge win. Many people think they're traders when they are more like gamblers who would probably have better odds if they went to Las Vegas. The difference between a trader and a gambler is like the difference between a casino and a gambler. The casino paradigm, introduced in Trade Like a Casino by Richard Weissman, has helped traders think differently and become more profitable. The casino doesn't risk it all in a single game. It has position sizes. Their table limits ensure that a single win doesn't impact their overall profitability. A casino doesn't have emotions. It doesn't care about the players or whether they're winning or losing. In contrast, a gambler can become consumed by emotion. A gambler usually has a problem taking their winnings off the table. And they may win sometimes, but gamblers will eventually lose it all in the end. Be the casino. I thought that was really good. So basically, the moral of the story is have a trading plan and keep your risk in check. And then explore, do your research, see what you could do that might give you an edge. And then if you're an outlier, tell us all about it so we can all have that edge. So want to jump right back into New Trader, Rich Trader. So I think Mikey Mike said that he got his copy of it yesterday. Did you start reading it yet? I know it's kind of like 7th grade. We're kind of reading it together in class, right? But I feel like this is very useful, and I hope that you're getting a lot of good information out of this, especially going back through and like these are the notes that I took. I don't even know. I think like 2014, 15, something like that. So it's cool to see the notes again. So we're on chapter 7. New traders bet the farm. Rich traders carefully control position size. I just recently learned about this. Lambos or food stamps. It's like a thing with the Reddit community, right? Like the Wall Street bets. Lambos or food stamps. It's either a Lambo or food stamps t-shirt. Let's see this. Yeah, that's not the way you should trade. Not at all. In fact, I think you should do quite the opposite. I think you should control your trading size. Your first job as a trader is to focus on the correct trading process, not profits. Now, on this is one of the things that I'm a huge advocate for, which is turning off your P&L. I want you to go into your broker platform the next time you open it up and turn off the P&L. You can have the percent on there, but don't look at the dollars. Do not look at the dollars. And I'll tell you why. Because when you see the dollars, right? Let's say, for example, you put on trade and you're up $10,000, right? That is so exciting. And then maybe you're up $40,000 and you're like, oh man, this is awesome. I'm up 40 grand on this trade. I could go buy a Tesla, right? You start thinking about all these amazing things you could do, and you stop focusing on execution. And then you see it go from 40 to 30, 40 to 20, and you're like, I'm still up 20,000. Who cares? I'm still making all this money. Who cares? And then you're up 10. And you're like, well, you know what? I could have got out when I had 40, but I'm still up 10. And then you're back to nothing. Or the opposite's true, right? Maybe you're in a losing trade and you see you're down 10 grand and you can't sleep at night. You're down 20 grand and you're like, how could I let this happen? Oh my gosh. And then you're like, I'll be a long-term investor in this case, right? I think we've all been there. But your job is to focus on the signals. If you get your signal, you have to act. And that's why I say turning off your P&L allows you to focus on the signal, focus on what is happening without the money emotion tied to it. Money is energy, right? When you remove the energy aspect of it and you can focus on execution, you will be more successful. Absolutely, you'll be more successful because you're taking away an emotional pull, the distraction, the excitement and the fear and the greed that we talk about, right? When you turn off your P&L and you only focus on execution, it gets way easier. Trading becomes so much easier. It becomes like playing a game. And when I say playing a game, it's like when you go in Mario and you're collecting all the coins, right? Hear me out. You're collecting the coins along the way, right? You're bouncing on turtles, you're eating mushrooms and all that kind of stuff you do in Mario. And you're just collecting your coins along the way, right? That's cool. And at the end of the game, you're like, I had 4,000 coins. But if you're going through the game and you know that every time you die, you lose all your coins. Or every time one of the turtles hits you, right, you lose your coins. Maybe Sonic the Hedgehog's a better example, because when you get hit in Sonic the Hedgehog, all of your rings like explode out of you, right? If you're focusing on, oh no, I can't lose my coins. I can't beat the game if I lose my coins. You're no longer focusing on the game. You're focusing on the coins. And you're focusing on the coins. You're losing your track on the objective here. And the objective with trading is follow your signals. So that's why I say turn off your P&L. Just turn off your P&L today. Don't ever look at it again. The only time I know how much money I'm making in my account is in a spreadsheet. I don't even know. I have it turned off in a way where the only thing that I do is I look at my position size, my opening and close price, and then the spreadsheet takes the difference, right? And then it adds in my commissions into it. So I don't even know in my trading account how much I'm up or how much I'm down, because I don't care when it's an open profit. Sometimes it's exciting. You're like, whoa, I know I'm doing good. And you can look at your P&L bar, like the percent scale, and you're up 12, 15, 30%. You're like, oh, this is great. But you can do the same and know like, hey, this is getting tight, right? I'm down on 6, 7, 8, 12%. Maybe I need to cut it. But when you put dollars with it, it changes it dramatically, right? So that's one of my pro tips. I pontificated on that far too long, but that is a pro tip I would absolutely recommend. There were significant problems with New Trader making this trade. It was against his trading plan, which you should never do. He didn't understand the nature of what he would be trading, right? It'd be like jumping into options for the first time, never having researched them or understood what it is. He had not researched the history of the stock's price, so he didn't know the potential for failure. Ooh, that's interesting. It was an all or nothing bet. If the options expired worthless, he would lose the entire trading account. Yeah, that's a big deal. That's a big deal. And with options, you can lose more than your trading account, which is also a really bad deal. Don't do that. Fortunately for him, his trepidation caused him to listen to another one of his emotions, fear. Fear can cripple a trader, but it's also helpful if you have enough fear to keep you safe from greed. And that's when it hit him. He was too embarrassed to talk a trade over with his trading mentor. If he was too embarrassed to talk it over with his trading mentor, he shouldn't be making that trade, which I agree, right? If you can't go on YouTube and explain why you made this trade, you probably shouldn't be making that trade, right? And for me, I want to see everything all lined up, and I think you should too. I think if a trade does not fit your entire trading plan top to bottom, right? Imagine that every stock out there could fit in a funnel and only a few are going to fall out right to the bottom. That's why I designed it this way. If you can't explain and articulate why you would take the trade, then you shouldn't be taking the trade. Why wasn't he watching the financial news? Oh, hang on. He arrived at Rich Trader's house unannounced in the middle of the week. He was surprised to see him answer the door in his PJs with a book in his hand. How odd. Why wasn't he watching the financial news? Why wasn't he at his desk, glued to his monitor? Dude, I would hate it if that was how trading had to be. Are you doing any trading today? I have some trailing stops in, so if my positions reverse, I'll be sold out. I'll check in the last hour of the day. That should sound familiar, to see if I should enter any new trades or any other stops. Huh. Sounds like us. New Trader was dumbfounded. He didn't understand how Rich Trader had an account this size, doing this for a living. He could be so blasé about his trading. And this is something I have picked up on, that I say flippant, right? When I'm in my trading, I can be very flippant in my trading, where it's just like, okay, this is what I'm gonna do. I'm in or out. Whereas some people get so tied up in the trades, emotionally speaking, on the dollars. So I can totally empathize with that. You've seen me do it too, for sure. Well, we all hate to lose money, but my sells are based on hitting a predetermined stop loss and not my opinions. I also trade a system, not my predictions, but what the market will do. There's no need to sit at my desk or watch financial news all day, because those things could cause me to be impulsive and make trades that go against my trading plan. The greatest determiner of your risk is the size of your trade. I would never risk more than 1% of my loss on any trade, maybe 2% if I wanted to be aggressive and go for larger returns. Mine, I was at 4% for a long time, and then 5%, and then recently I bumped it up to 7%. And things are working great, right? And you can be the judge of if that's going to work for you, right? If I was putting on 7% trades, 7% of risk, and losing 7% each time, I don't know if I would continue to do that. But the way that I've structured it is I'm putting on 7% of 7% risk size, not position size. Position size is more like 15 to 20. 7% risk size, and then my average is like 2% hit to the account, positive or negative. And it's like, I can trade really big, and yet the actual change to my account is roughly about 2%. positive or negative. And that's okay with me. The more aggressively you pursue returns through exposing your account to risk, the greater likelihood of larger drawdowns in capital. Good trades are generally ones which show a profit from the beginning. Yes, I fully agree with that. So if you don't keep a constant position size and good risk reward, you'll distort your payoff ratio. A payoff ratio? What is that? Basically, the ratio of the average winning trade to the average losing trade. The larger this ratio is, the better chance you'll have a winning strategy. It's difficult to be a successful trader with a payoff ratio under 1.5. The ratio is calculated by dividing the gross profits by gross losses. Most traders want at least $2 of reward for every $1 risk, which is what the 5% loss versus a 10% win scenario with the 50% win rate would get you. What is my payoff ratio? 10 seconds here. I got it. So I'm going to look at the master key because this is what we have been trading exclusively since July. So my payoff ratio is actually not that huge. I've got it right here. It's 1.1. Now, I will tell you that I would love to see that higher. Without a doubt, I'd love to see that higher. Steve was saying, you know, you'd really want 2 to 1, right? For every 10% win, you have a 5% loss. But here's the deal. An 80% win rate, oh, you can't see that, sorry. An 80% win rate trumps trying to get 2x higher, right? If this was at 50% and this was at 20 and 10, then that would be more along the lines of what he's looking at. But an 81% win rate, which is what we've been trading since July, that is astronomically huge. So you don't have to take as much risk in this case, right? Because if you're waiting for those 10% returns, you could be waiting forever. It's not whether right or wrong that's important, but how much money you make when you're right and how much you lose when you're wrong. What's the note on here? It says popular point. That's from George Soros, which before he became the bad guy from Batman, was actually a incredible trader. An important and often overlooked trading dynamic is the importance of taking trades that have the potential to be big wins or small losses. Big losses will deplete your account quickly, and small wins will do little to pay off those losses. Trades need to be asymmetric. The downside is carefully planned and managed, but the upside is open-ended. This is an important element of successful trading. So that's going to wrap it for today, right? Of course, there's so much that you can take away with trading, and this is why New Trader, Rich Trader is one of my all-time favorite trading books, and I'm really glad that we can do this together because I feel like it's super helpful, right? Especially since, I learned so much from this book in particular. That's why I say that everybody should read it. What did it cost you, Mikey Mike? Like $8? All right, let's jump into New Trader, Rich Trader. As I mentioned a little bit ago, this is one of my top 5 favorite trading books. And in the times when I'm not trading, I think it is our best interest, all of our best interest, to go through and learn some things about New Trader and Rich Trader. If you haven't got a copy of this, it's probably $8 on Amazon. Totally worth your time to go grab. And the highlights on here are actually the very first time that I read it back years ago when I started working with Steve. Sebastian says, FYI, while Trump won the USA government, in Germany is imploding. I want Donald Trump in Germany too. Oh man, I didn't know Germany was having problems. Don't forget, Sebastian is hosting us at next year's Oktoberfest for our first annual outlier convention over there. So let's go to chapter 8. It says, for new traders, large profits are the #1 priority. For rich traders, managing risk is the #1 priority. Didn't it say it in chapter 7? Oh no, it didn't. It was similar, but different. All right. First, you have to control. Wait, no. First, you have the risk that your trade will be a loss. Before you put on a trade, you've got to understand, right? Even with an 81.8% win rate, I know that any trade can be a loss. Any trade. And that's one thing that I really like to stress is that your last trade could be a winner. Your next trade could be a winner. But this trade that you're on right now is completely separate from those two events, right? The trade that you put on earlier and the trade you're going to put on next do not have any impact on this exact trade. They are completely independent circumstances from each other, right? So you need to treat them that way. Every trade you put on has the ability to be a winner, and it absolutely has the ability to be a loser. You don't know in what sequence you're going to have these winners or losers. So you can't just bet the farm. You can't go Lambos or food stamps, because any one trade could be the one where you get the food stamps. And I don't want that for you. You have to you have the risk that your trade will be a loss and that it will move in the opposite direction of your long or short position. This is your standard trade risk. However, you can typically control the maximum amount you lose through position size and a stop loss. That's what I said. Every trade that you put on 2 risk parameters here, right? Your position size saying, I will not put on more than X% of my account at risk. And then your stop loss saying, even if I put it on, I'm still going to get out at this in the market, right? Putting those 2 on is what keeps you in the game. Everyone wants to talk about the winners, but nobody wants to talk about the losers. And the losers, how you handle the losers, are the way you either become insanely wealthy in the market or you become completely broke from the market. It's not how you handle the winners, it's how you handle the losers. You also have the general market risk factor, which is why I always start with the market, right? Always start with the market, because the market's going to tell you which way it's going. I'm glad that we had that discussion just a couple minutes ago, because the market will tell you, right? The general market factor. I have made the mistake, and it's cost me a lot of money, trying to go short while the market's going long. I've also made the mistake of trying to go long while the market's going south. Don't fight the market. Just ride with it, right? A surfer doesn't get on the surfboard and then go against the waves. The surfer gets on the surfboard and lets the waves push him forward. That's the way you need to view your trades, right? You're just going out to the market and letting the market push you. That makes it way easier. You can pick the stock of an amazing company, but if the trend of the market itself is down, then it's likely your stock will also fall. Regardless of fundamental merits of the company or the past strength of your stock's price movement, nothing is guaranteed. The market is like a tide that comes in, it lifts up all ships, and then when it goes out, it lowers them back down. I heard the phrase that I like to repeat this phrase: a rising tide lifts all ships, but a falling tide shows who's swimming naked. You can make twice as much profit when you're right. Oh, what's it say? Oh, penny stocks here. Risky penny stocks and small caps are not marginable. Hang on. It's talking about different margin risk. You can make twice as much profit by using margin, but you can lose twice as much if you're wrong. This increases your risk of ruin by making your losses compound twice as fast. Ain't nobody want that. Okay, here we go. Here are some simple suggestions to help lower your risk when you trade. Some of these you probably have heard before. Ready? Quite a long list here. Let's see, like a whole page worth. Determine your stop loss before placing a trade. Honor your stop and cut your loss. Balance your wins and losses by trading the same position size in capital on every trade. All of this should sound familiar. All of this is what we do on a daily basis. When we position size in capital on every trade can be determined by the ATR, right? Because the ATR is going to put the same equivalent risk on 2 very different stocks. Only make trades that meet the criteria of your predetermined trading plan, Randy, Dave, and everyone else. Trade primarily long in uptrending bullish markets and mostly short in downtrending bearish markets. Or go to cash. A 10-day moving average over the 50-day moving average is a good sign of an uptrend, and the reverse is a sign of potential bearishness. Only use margin to trade more trades of equal size. You won't typically have to wait 3 days for your trade to clear to get your buying power back, and you can keep trading after all trades are closed. Don't use margin to make one large trade, but instead use it to create a quicker turnaround for all of your capital. Only trade in stocks with over 1 million or more shares traded daily. That sounds familiar. Only trade options of open interest of over 1,000 contracts. We don't always see that. we don't always see that. My rule is 250. Now I got that. I forget where I got it from exactly. I think I got it from an options course I took with Ally Financial. They had an options broker at one point. I can't remember what it was, but it was this course that I was reading through on there, and it was like make sure that the open interest on your the open interest on the strike that you're looking to trade is at least 4 times as big as what you're going to trade. So I'm like, well, if I'm trading 60 contracts, 4 times that size is 240. Okay, I'll deal with that. So 250 has always been my go-to from that point. You can avoid overnight risk as a day trader, but the most profitable traders carry trades for weeks or months. You can mitigate overnight risk by going to cash when an announcement, like earnings or the elections, is to be delivered after hours. Manage volatility risk by trading slow, dependable stocks which have consistent daily ranges. So he didn't use ATR in this example here, but that's what we do with ATR, right? We establish how much volatility risk they have. A stock with a beta of 1.0 moves the same as the S&P 500. A stock with a beta of 2.0 moves twice as fast as the index. You want to trade lower beta stocks to manage volatility or position size based on ATR. You don't need a volatile stock to make money. You need a stock that's either in a trend or in a price range with support and resistance levels, which in that case, we'd use as order blocks. You can control, here we go, political risk by trading stocks that do most of their business in countries with historically stable governments, such as the US, UK, Canada, Japan, and rather than emerging markets. I'll tell you what, now that Donald Trump's going to be president for the 47th time, businesses in countries with historical stable governments, I'm so glad that we're going to be a stable government again. You can limit the risk of time decay. Ooh, wait for this. You're going to love this one. You can limit the risk of time decay with options by trading deep in the money calls and puts. Most of these are pure intrinsic value and have little time value, if any. So even though they may cost more, you eliminate the risk of time running out before they go in the money. Huh. Isn't it so weird to see all the stuff that I trade around in this book, like written on paper? That was done, geez, what year was this published? Let me see. 2017. This must have been like a second edition. Oh yeah, new edition. This new edition. The classic just got better. Yeah. And it's pretty obvious that I worked with Steve. All right. Remember to double check trade information before you hit enter. I've accidentally traded 10,000 shares instead of 1,000. You have seen me sell a call when I meant to buy a call, right? That was not all that long ago. And I was like struggling. I was trying to get out and I'm like, what the fuck? What's going on? And I'm like, how did I get short this? And just going back and forth. And then I was like, I have to get out of this immediately. I never wanted to be in that trade at all. But that does happen, right? Trading errors do happen, right? He's saying take a second to just double check. Have a plan B for your broker and internet connection. I always keep my broker's number as a favorite on my cell phone. As you've heard, I have had to call Tastyworks at least 3 times this year, and I've spoken to a person within just a couple minutes, which is great. And I've set up a hotspot so I can get online quickly if my home network ever goes down. On that topic, if you trade on your PC, download your broker app to your phone. That way, if your PC ever goes down, right, if your Wi-Fi ever goes down, you can still use your phone internet and your phone app to get the trades placed, right? Because there are days where you're like, I have to get out of this trade. Rich trader's tip. I never want to lose more than 1% of my account in any trade. If I'm trading with a $100,000 account, I don't want to lose more than $1,000 on a single trade. A stop loss level should start at a price level you know that you will be proven wrong and then work back to position sizing. This I like because the way that I like to trade this, right? Like, let's say, for example, if I was going to get into the market right now, I like to put a half ATR value. So if I look down here at the ATR value, the average true range over the last 14 days is 6.38. So 6.38 divided by 2 is $3.19. So I'm giving it $3.19 to prove if this trade is going to work. And on a $500 stock, nearly $600 stock, that's not very much. But that's what he's saying here is that get out, put your exit position at a level that proves the trade isn't working. Not at an arbitrary level, not at a place where you feel good about it. But listen, if it's not going to go up in ATR, but if it goes down half an average true range and it starts to set a new range lower than the price you bought it at, you don't want to be there. So that's why I give it that much. I give it half an ATR to prove to me if it is going to work. And if it doesn't, that's okay too. I'll just move on. If you're only risking 1% of your trading account, when you're wrong, every trade can just become one of the next 100 with little emotional or financial impact. Doesn't that sound like what I preach? You will survive losing streaks and increase your odds of long-term success. Man, I'm so glad we're going through this. I really hope this is useful, right? I feel like I'm getting a ton just rereading it with you. Let's shift over to New Trader, Rich Trader. For those of you who don't know, we've been going through New Trader, Rich Trader chapter by chapter. One of my top 5 trading books out there, and I absolutely recommend you pick up a copy on Amazon. It's going to cost you like $8. And the Kindle version that we have on the screen is actually the very first edition I ever read, and I've got the paperback, the Kindle edition, the audiobook edition. It's great on Audible if you want to get that. But it's really fun to go through because you can see my notes from like a decade ago, and I've worked directly with Steve Burns, and you can see a lot of what I do in the trading room directly from the quotes in here written by Steve Burns. So it shouldn't surprise anybody as we go through. So we're in chapter 9. New traders try to prove they're right. Rich traders admit when they're wrong. The market gives no cares, no shits about what you think. The market will do what the market does. You have to admit you're wrong, or you will be blown out. Let's start this paragraph here. New trader watches more of his money slipped away. $8.98 was the last quote. Now he was down $185. He was heading into the territory of the most he wanted to lose on any one trade. His lack of discipline, inability to stick to his trading plan, and his refusal to honor his trailing stop had cost him an additional $135. Dude, it sucks. I know, especially we went through that on BX. Do I still have the chart for BX up? Yeah, we went through that on BX. I was very frustrated because it got right at, let me make this bigger. It got right at my half ATR level, and it closed a smidge above there, right? A smidge above there. And I said, okay, listen, I mean, if you remember, we watched this for a good 30 minutes because I didn't want to move until I got confirmation since it was right at that point. And I said, okay, that's what I'm going to stick with because it is going to close right above my half ATR stop point. I'm going to hold it. And if it doesn't work out, it doesn't work out, right? It ended up being like a 2% loss in the account. I'm going to live on a 2% paper cut. But it's frustrating when you get to those points. I will absolutely agree with you. I would much rather have it way down below my stop loss or way above my profit-taking target if that's what you do. Because it's a way easier judge than when it's kissing it, right? When it's kissing it, it's frustrating. It's demoralizing. It's like, what am I going to do? But if you have your plan, you just follow the plan. Now he understood that he could lose money on any trade. Oh, geez, give me a break. Now he understood he could lose money on any trade. Who doesn't feel that way? And that he could control what amount that was. Now that's the epiphany right there. You can lose money on any trade, but you can control how much that is. He realized that if a stock met his exit price, trailing stop, or stop loss, the odds were that he was wrong about the trade. He should take that as a signal to get out, right? If at any point in time it's closing below that level, it's a signal. Listen, it's just not going to work out. It occurred to him that it was a lot like insurance. He didn't get mad paying for car insurance. Dude, car insurance has more than doubled in the last couple of years, going back to inflation. I'm pretty mad about that. Home insurance as well. I get mad about that part. Even if he doesn't need it for that month, he doesn't get mad about paying for it. But if he were to total his car, his insurance would protect him from financial ruin. Sure. Rich trader's tip. I don't think traders start making money until they mature and can see the big picture. We can easily become unrealistic and go down the wrong road. It's crucial that we stay on the road to success. If you need to ask others for their opinions on a trade, stop trading and develop your own trading plan. It'll take time for you to create your plan and to test your strategies. But if you're willing to put in the hours involved, if you're not willing to put in the hours involved, you're not going to make it. So, pretty short chapter today. Here's the takeaway, in my opinion, is you can always control your risk, right? I think Steve taught me this quote. He was like, you never actually know how much you're going to win, but you should damn well better know how much you're planning to lose. Before you get into any trade, you should know exactly how much you're willing to lose. But the win, that's open-ended. I don't know how much I'm going to win, but I know exactly how much I'm willing to lose. Jump back into New Trader, Rich Trader on chapter 10. So this goes back to what I was saying earlier. Steve Burns is a great friend of mine, wrote this book, and this is the second edition. And I think one of y'all mentioned that there's probably some updates from the time that Steve and I actually worked together, because there's so many questions and things that I had while working with Steve that seem to have got right into this book here. But as we go, and as you've noticed, a lot of how I trade, specifically is how I trade, is written down in this book. So let's jump into it here and let's continue on. We're in chapter 10 today. New traders give back profits by not having an exit strategy. Rich traders lock in profits while they are there. Now, that's one of the reasons that I'm so adamant on my exit strategy rules here, right? All of these rules, it's an anything happen type of thing, right? If any one of these things happen, you got to get out. You got to lock in those gains, right? And especially as the trade's working for you, in my opinion, you want to take that tolerance that you're giving it, right? Let's say you've got a $2 stop loss. You want to take that tolerance and squeeze it, okay? Because you don't want to see those winning trades turn into losers. That sucks. That's no fun. And that definitely hurts your bottom line, right? So one of the things that I like to do is once the stock is profitable, I'm no longer keeping that half ATR as my exit point, right? As my one stop loss point. I'm now moving that up. Okay. I'm moving that up to below the prior day's low once we've rolled it, right? Once we've established some profits are there, instead of just like, oh yeah, it's up 10% or up 10 cents, I should say. We've got profits. I mean, you do want to give it some room, right? You go to the gym and you're doing some bicep curls, right? Not every single one is going to be the most perfect form going from 0 to 100, right? You're going to have some where you're struggling a little bit. Maybe it's going up to 10, maybe back down to 5, and then up to 20, right? Maybe you're struggling. It's still moving in that direction, but you're struggling to get it up. And it's like, oh, sweet. Okay, I'm at the top. And now I'm going to let it down. I'm only going to give it this much room to come down, right? I'm only going to give it 10% to come back down to say, okay, I'm out, right? You've got to be able to allow it to work, but also not cut off the trade, not choke off the trade. So let's continue on here. So the question here is, what would you suggest is the best way to lock in profits using a trading plan? He said, that depends on your trading plan, methodology, and system. Trend traders like me tend to take profits when trailing stops are hit. Exactly what I was just talking about. However, sometimes we have sell signals as the stock falls through a moving average, right? If it falls through the 10 for me, you got to get out of the way. Falls through a moving average, hits support, or hits a new low for a certain number of days. We always let profits run as far as possible. We want to give the stock an opportunity to catch the big trends. A trend trader must capture large wins to pay for all the small losses. Absolutely. If the last 4 times the stock increased 8%, 7%, 10%, and 12% in the 4 weeks prior to earnings, it would be prudent to take profits when the stock was up in that range, right? So if you trade into earnings and you've noticed in the last 4 earnings cycles last year, that's gone up 8%, 7%, 10%, and 12%, in the couple of weeks leading up to it. That could be a great trade for you, right? But it would make sense, as he says here, to take your profits as the stock pushes up into that range. You could also set a stop if it retraces to 7% when it's up 8% or more. So if it goes up to 8 and it comes down to 7, you could get out. If you're up 10% in the trade, the odds are that you already have all the profits you're going to get, and you need to start looking at taking them. So I'm glad that came through, because this goes back to the topic we discussed last Friday, right? If all the profits are there that you're going to get, you need to start taking them. So if we go back to the last week or so, definitely some frustrating trades. And one thing that I noticed was going back through these trades that all of them had a really strong run up beforehand, right? And so I did some data back testing. I looked back and we came up with a new rule, which is if it's gone up 5% in the last 5 days, that may have already been the outlier move that we're looking for, right? If the move has already started, we're not trying to get in at the very top, clearly, right? So for example, FTNT last week was up 23% before getting in the trade. That's the outlier move that we're looking for. And had we got in when it was only up less than 5%, that would have been a way better entry point. So just a little rule. Mark mentioned in the Discord that the rules that we have here is just filtering out noise, right? And so it definitely will be helpful in the next coming weeks and years and months that we work together to have that in the bank. Dave says, that was a lesson I learned last week. Take the profits when they're there instead of hoping for a bit more. You can always hope for a bit more, Dave. There's nothing wrong with hoping for a bit more. The thing that I always say is, A, turn off your profits. That way you're not stressing on how much you've made and how much you've lost, but you're focusing in on your exit signals, right? If you've got your signal and you didn't take it, that's a problem. That's a huge problem. If you got your signal and you did take it, that's a great trade, right? Larry Height, one of my mentors, the first $1 billion hedge fund manager, original market wizard, he has 4 different trade criteria. There's good trades, bad trades, winning trades, and losing trades. You can have a good trade that's a losing trade, right? Because you followed your plan, you followed your signals. But you can also have bad trades that are winning trades because you just happen to get really lucky, right? You want to make sure every trade is a good trade. But the outcome, if it's a winner or a loser, can be random, right? You put everything in your favor, but at the end of the day, the outcome, where does it fall in the profit and loss spectrum? We can't control that point. We can only control where we get in and out. So by all means, make sure every trade is a good trade by following those entry and exit signals. Bob says, hopium always dulls the better instincts, for sure. Okay, let's get back to this. You had bad luck combined with an overextended profit. Oh, overextended. We learned about that last week, didn't we? And a failure to follow your trailing stops. Yes, all of the above. Well, that was a learning experience. That's what I say, right? You either win or you learn, right? That's not, I didn't come up with that, but you either win or you learn. There's this great book called Psycho-Cybernetics, and I would highly recommend picking it up. It's a self-help book, like a personal development type book, like a Tony Robbins type book. And one thing that it talks about is like, imagine you're shooting basketballs, okay? I'm not a sports guy, but imagine I go out and I shoot basketballs, and I guarantee you I'm going to start missing up front, right? But every time that I'm shooting those balls, I'm actually making small micro adjustments automatically without subconsciously not knowing exactly what I'm doing, right? I'm not saying, okay, if I give my index finger slightly more pressure, and then the ball will go this way and get closer to the hoop, right? You're doing this over and over subconsciously, and you have, he calls it the automatic success mechanism. So you're either getting it right, you either win by getting it in the basket, or you learn. So you're course correcting, right? You're adjusting, you're learning. So the next time you shoot, you're getting closer and closer to the basket. And I think that definitely applies here, and really anything in life. You either win or you learn. And sometimes you need to have that kick in the pants to get you to, hey, this happened before, but you didn't notice. Maybe you need to notice this again. And in my opinion, that's kind of what happened last week. Well, that was just a learning experience. That's also how plane crashes happen. It's never just one problem, but a combination that results in catastrophe. There are too many safeguards in place for one thing to cause a catastrophic plane crash, which, we talk about all these different things we do to safeguard ourselves, which is position sizing, which is knowing where you're going to get out in the chart, and of course, following those plans. You must focus on controlling your risk. When a stock moves against you and hits your stop or gaps down below your stop, you got to get out. This is your insurance against ruin. Your goal is not to be right every time. Your goal is to make money over the long term. This is accomplished by your winners being bigger than your losers and focusing on being right big and wrong small. All right, so series of rules here. Read your trading rules and trading plan every day. And that's honestly one of the reasons what I do love about having the strategy up here on the screen is you can just, not just you, but me, can go through and say, okay, did I do this part? Did I do this part? Did I follow this rule? Did I do this thing? Right. And it's keeping myself honest. Never hope for a bounce back. Cut your losses at predetermined stops or trailing stop price level. Okay. So I'm going to get real honest with you here. Anything can happen in the market, right? So AEE hurt last week to take off, and it's almost back to where I got in. That sucks, right? But FTNT is down several more percent from where I got in, which also hurt last week, right? Both of these situations occurred. We can't predict, it's a coin toss if it's going to go up or down after you get out. So if you come to a trade and you don't get out because you're hoping, where's it at? You're hoping for the bounce back, right? It could totally happen where it comes back and maybe you get out with a scratch, or it could continue on down, totally wrecking your plan. In fact, one of my favorite graphics I like to talk about on this is this one here from Mark, right? You buy here and it goes up and comes back down, which is what happens, knowing you should sell your stock when it does this, but fearing that it'll just turn back around and come back up. But what really happens is you get caught in a huge, huge loser. We've all been there. Trust me, we've all been there. The way you avoid that is by just following your plan, right? You never have to have big losers ever again if you just follow your plan. Always exercise discipline. Follow your predetermined trading plan. Don't overtrade. A successful trade is a trade that follows your trading plan and your system. Do not take a random trade, right? Who was that the other day? That Randy and Dave. Do not take random trades. If they don't follow your plan, do not trade them. Don't allow outside distractions during entries and exits. When you're trading, focus only on trading execution. So one of the things that has happened to me is as I'm going through, making my trades, talking through the trades, I can sometimes get distracted, and I have, on occasion, made some trading errors because of it. You don't have to do that, right? You don't have to sit here and talk to people as you're making your trades. You can sit there and focus and go step by step by step, which is what he's saying here, right? And I would definitely prefer to do that, but then again, I wouldn't be able to trade with you. So we got to make sure that you're following your rules and just focus in on the moments when it counts. Your opinion doesn't matter, only price action. It's kind of what I was saying earlier. Never try to predict. Follow trends, trend reversals, and your signals. Never fall into the trap of hindsight. Instead, focus on real-time trading. Randy. Peter, I see your question. We'll come back to that after this. Always respect the market and don't become arrogant, right? It's critical that you learn from your mistakes as quickly as possible and that you try not to repeat them. Man, it's almost like Steve wrote this for us after last week's trades, right? You learn from your mistakes, make new rules, and that way you don't repeat them. The timing on this is pretty awesome. The market gives you instant feedback about your performance, but you have to pay attention. In fact, that was one of the things that I said before was on BX, which was my worst trade of the year at that point. That one actually had ran up nearly 10%, and then it started going sideways. But I mean, since then it's gone up even further. But the outlier move happened here and over here, and I got caught in the middle, right? But if I had paid attention and said, hey, you know what, Chris, this trade was up nearly 10% before you got in, it might be a little bit too far, right? It might be a little extended here. So you have to pay attention. I missed that one. I missed that. Rich trader's tip. In trading, the money isn't made on the entry, it's made on the exit. The art of the exit is critical to a trader's success. Profits can disappear if you don't take them at the right time, and small losses can become big losses if you don't cut them short. Alternatively, small profits can become large profits if you let them run until they stop moving in your favor. And finally, keeping capital tied up in a trade going nowhere can cause you to miss out on a good opportunity. You must have a plan to get out of every trade you get in. Get out of every trade before you get in, right? Have those reasons to get out. Before each trading day, think about what you'll do based on where your trade is and where it may go. Exits are meant to minimize losses. and to lock in winning trades for maximum gains. An exit strategy is meant to allow your logical mind to make decisions on how to exit before your emotions get involved. And the easiest way that I found to get your emotions uninvolved is turn off the stinking P&L. Doesn't matter. Does not matter what your open profits are. You can calculate your close profits after it's done. Does not matter what your open profits are. You are setting yourself up for an emotional roller coaster, good or bad, and you will absolutely leave your logical mind on the table and forget about your plan when you see the dollars changing. So turn off that stinking P&L. It'll make your life a lot easier. All right, to Peter's question. Is there a difference in a 5-minute order block and a daily order block? Does it differ in strength? So Peter, to that point, let's go to a chart here. We can go on BX here since it's got a order block right there. So in my opinion, I would say that the daily order blocks would be significantly stronger than a 5-minute order block. So if I go to a 5-minute chart, I mean, order blocks are so crazy, right? So you can see earlier today, it went up, it created this block here, created a second block right here. And then it went up into this area, created the day before. Rejected, rejected, rejected. 3 times it was rejected. And then on this fourth one, it seems like it might be going through. And then it came down to this level, got pretty close, rejected, pretty close again, rejected. So it really is all about your time frame, Peter. Order blocks are so sick. I mean, order blocks are so sick. I can't believe how fortunate we are to have order blocks when 100 years have passed of trading and it wasn't right there, right? But just that's a perfect example. That order block was created yesterday and it went in and out multiple times. So in theory, if you wanted to trade the reversals off of that, right? Let's say you wanted to day trade and it goes up into this order block on that first red candle back down, you could trade that. And then again, first red candle back down, you could trade that. It's not how I trade. I'm not telling you to trade that way. But it really, Peter, all depends on if you are day trading, you need to be focusing on those time period charts that you're looking at. But you can layer that in, right? You might want to say, okay, I know on the daily, it's got an order block up here. On the hourly, it's free of any order blocks. On the 5-minute, it's got some order blocks here. So I would stack them personally, but just not how I trade. So that's going to wrap it for today. I'm not going to leave you out in the cold. We're going to cover New Trader, Rich Trader, right? I think we're on chapter 11 at this point. And this is one of my top 5 favorite trading books that I recommend people pick up. It's the best $8 you'll ever spend. Mikey Mike, I think he just finished this. Mikey Mike, let us know. Was this worth your time to read through this one? But what I'm doing is I read this ages ago, and I worked with the author, Steve Burns, early on in my trading career. And it's fun to go back and see these highlights that I made literally ages ago. I would tell you at least a decade ago. Part 3, methodology. Chapter 11. Most new traders quit. Rich traders persevere in the market until they are successful. The best way that I could describe that to you is, and I've told this story a few times. I was sitting on the couch one day, and my son goes, "Dad, how long are you going to be trading stocks?" I'm like, literally until I stop breathing. I mean, why would I ever stop? It's not like I have to go dig ditches, right? It's not like I have to do anything manual. It's not like I couldn't do the same trading that I do today that I did 5 years ago that I could do 10 years from now or even 50 years from now, right? Trading is the hardest way to make easy money, is what people like to say. But truly, there's no reason not to trade, right? When you have the ability to, when you have a way to make money, well, it means you should trade until you can't trade anymore. Peter says, next one should be the complete turtle trader. Let's do that. I was actually thinking about that today, specifically because Mikey was asking about the ATRs, and I got that rule from the turtle traders. So that is definitely something I think we will pick that up next time. Really good idea. Still a bit more left. Well, let's work on that today. The 10, 21, and 50 day. Oh, here's the rule. This is what I've been looking for a while. Okay. The 10, 21, and 50-day moving averages seem to be the ones that affect the stock price most. 10, 20, 50. Sound familiar? When he expanded his charts for long time frames and looked at the price action of the stock indexes like the S&P, Dow Jones, and NASDAQ, it looked like the 100-day and 200-day also came into play as lines of support and resistance. It seemed like if a stock or index broke those lines, it was hard to get them back over or under them, possibly signaling a change in the trend. It was fascinating. Stocks of smaller companies seemed to move faster than larger companies. He also noticed large companies were more likely to be range-bound than smaller ones. Bollinger Bands caught his eyes. There's so many different indicators, right? Bollinger Bands, MACD, RSI. I don't want to, especially when you are a newer trader, I don't want to suggest going down the rabbit hole of indicators because you could go till you couldn't even see your chart anymore. You could fill it up with indicators. So he talks a little bit about different indicators here. The correct buy signal seemed to be on a pullback to support or high volume breakout to new highs. And the hot stocks he was eyeing, the pullbacks were usually at the 10-day moving average, right? And that's what I say is keeping things on the north side of the 10-day moving average. That goes along exactly with that. Stock prices weren't based on a company's underlying valuation. No. Whoever tells you that is smoking something. Instead, prices are a composite of all the traders' opinions about the future expectations of making money on the stock. Could fear and greed drive prices more than a company's value? Huh. Tie that into outlier right there. He was a man on his mission, and he jotted down key lessons on growth investing. Trade stocks with double-digit earnings year over year. I don't look at that. Some people do. The general market direction determines the direction of your stock. The general market direction determines the direction of your stock. Always start with the market. The market tells you where it's going. Only trade the leaders in the hottest industries. To guarantee they're liquid, pick stocks that trade at least 1 million shares per day. Greater than 1 million average daily volume, right? These are not my rules, okay? I learned from the greats. And then all I did was trade them online for everyone else to see. That's really all I did. Look for stocks that are close to all-time highs and have great support. Stocks that have new products with heavy consumer demand or a new business model with an edge in an industry should have the highest earnings expectations. Think of like Apple, Amazon, Nvidia, right? Those areas have seen tremendous growth, right? Tesla, those are the type of companies he's talking about. Stay away from illiquid penny stocks. Trade stocks on major averages, major exchanges. Cut losses on a stock's price at predetermined amounts. 7 to 10% maximum with position size, 10 to 20% of total capital. Never invest in a stock that is at the beginning of a downtrend. So, okay, at the beginning of a downtrend. Where's my cheat sheet? The 10-day EMA is an indicator of the short-term trend, okay? So if you find a stock that is closing under the 10 EMA, the short-term trend is down, right? The short-term trend currently is down. So what he says here is never invest in a stock that is at the beginning of a downtrend. So it needs to be for sure over the 10 EMA. Never bet against government taking corrective action in the economy. To win at trading, you must think and act like a winner, not a whiner. A trading system success is directly influenced by a trader's discipline. Listen and learn, but also verify the source of whether what you're hearing. Listen and learn, but also verify the source and whether what is being taught will work real time. So, caveat to that. My early career in trading was really frustrating. I was selling lots of calls, selling lots of puts, and the people who I learned from, basically they said, hey, when the market's going up, sell calls. When the market's going down, sell puts, because the market always corrects. The market always goes back to, gosh, I can't remember what they'd say. Like the market always goes back to the mean or back to the average or something like that. And I totally bought into their methodology. And they were big advocates of the efficient market theory. The efficient market theory basically says, and for those of you who don't know, the efficient market theory, let's go down that rabbit hole for a minute. The efficient market theory says that a stock's price has an equal opportunity to move one way or another, right? Imagine that this is today's price and it could go anywhere in between here. Okay. Think of a bell curve at any point in time on a stock. Okay. But what people have learned in practice is that the efficient market theory is not real, right? However, imagine for a moment with me. See if I can do it. That's not going to do it. Hang on. No, stop. Delete. No, hang on. Remove this polyline. I'm going to have to draw. Okay. Imagine for a moment that the efficient market theory says at this point here, you've got an equal chance of moving in anywhere in here. Okay. And so far we have, right? That's what the efficient market theory says, that there's a probability assigned to it going to this value, and it is just as equal as going to this value. There is no difference in between. But the problem with that is all the times that you have seen a trend. Anytime you have seen a trend like this, right? Anytime you have seen a stock move this, right? So let's say this is the beginning of that efficient market theory, right? You could say it'd be like this. The efficient market theory can't comprehend a stock moving completely 100% outside of these arbitrary bands, these arbitrary ranges that it wants to put in place. Let's see if there's any better visuals. And I gave up listening to them and decided I was on the complete wrong track when I heard them say specifically one day that trends don't exist. And reversion to the mean. Thank you, Brian. That's what I meant to. I don't know why I couldn't think of that. Their thought was trends don't exist. How can a trend exist if it's going to revert to the mean, right? The mean being equal. Let's say if the stock price is 100 and it moves up to 101 and back to 100 and then 99 and back to 100. Their whole theory is stocks revert to the mean. That's the efficient market theory. And then they try to come up with this cockamamie data point where they said trends don't exist. And they said the likelihood of seeing, X number of days in a row where the stock is moving in one direction, like how many times does it move 2 days in one direction, 3 days in one direction, 4 days in one direction? And they didn't want to take into account the fact that, you know what? It may not be all that often when stocks go 1, 2, 3, 4, 5, 6 days in one direction. That may be one time in every, 500 candles. But they really didn't take into account the fact that, oh, wait a minute, it can still have a down day, can't it? And then continue on its trend. And even still have several down days and then continue on with its trend, right? The efficient market theory has been disproven time and time again. Brian says, prices do revert to the mean over time, but you cannot know when it will change. They failed to mention that. The bell curve is real. I suppose if you look at it on a broad enough time horizon, that this will eventually go back to the mean, right? But if we're looking from over the last year, November last year to November this year, I'd say that it's, is it possible? Oh yeah, for sure. Right? Imagine this is the bell curve. Right? Is it possible that it could come down into here? Yes, absolutely. But the fact that it's like been outside that expected move the entire time kind of debunks it almost every time you look at it. I don't know, Brian. I think that rather than looking longer term, I think the efficient market theory could work in a shorter term, right? Maybe in like a 2-week time frame. But even then, you get those outlier moves. And here's the thing that's hilarious to me is that when it has a 3 standard deviation move, that's equivalent to 1 in 10,000 times, right? 1 in 10,000 times will it ever move like that. And I remember getting to this Twitter argument one day back when I actually cared about that kind of stuff on the internet. And this person was like, oh, this is the second time this year that it's had a 3 standard deviation move. And I reply back, I was like, you realize that's a 1 in 10,000 year occurrence that you just said has happened twice this year. I mean, could it happen? Yeah. Or your data is completely flawed. The mean would change over the course of the year, not back to beginning year start time. Or I just don't have a good representation of it graphically, because everything that I've seen is like this right here. Okay, maybe not. It's like this right here, where it says if this is your 0 point, then it's as likely to go up to, let's call it 10 over or 10 under at any point during that time, right? So it's not necessarily that the average changes and moves up with it, but that from 0 point to today, it is as likely to be anywhere inside of this range as possible. Your vote is flawed data. Yeah, I would agree. I would agree. All right, let's go back over this. Okay, don't start trading real money until you have done due diligence on your system. Never trade without a written trading plan. Reduce your risk of ruin, still making an acceptable profit. I think you meant to say like but or and. Your system should show your equity curve growing in past backtests or paper trading over the course of a year. Have an accountability partner whom you can talk to about your trading. I'll say, having you guys and ladies actually has made my trading way better because I have to be accountable to you. But isn't that the difference between possibility and probability? I don't know. Brian, you know what'd be really cool is if you and I could have a cigar and a glass of whiskey and have this kind of conversation one-on-one. That would be really cool. I'd love to do that sometime. And anyone as well. This is my jam. Keep a trading journal with as much detail as possible. And I couldn't agree more to that because by having that trading journal, you can always go back, just like I did last week, and reference those trades and be like, okay, wait a minute. There is a pattern here, right? There is something here. There is something to this point. Maybe, and then you can test your data, right? And you'll never do that if you don't have the data to look at. New traders will be tempted to give up, particularly when they see that the first few years are more about studying and learning rather than making money. But here are some compelling reasons not to give up on trading. It'll teach you about yourself. It'll make you better in another aspect of your life. It can create a consistent stream of income, and nothing else offers the same level of control of your personal finances and future. So yeah, great book. Super stoked to be able to share this with you. So we still got a little bit of time. Let's jump over into New Trader, Rich Trader. And for those of you who are following along, I've been going through this chapter by chapter. I read this book ages ago. First way I read it was on the Kindle. So that's what I got pulled up on the screen here. I would highly recommend you go get a copy of New Trader, Rich Trader. It doesn't cost me anything or doesn't earn me anything, but it might be the best $8 shoe ever spend. Oh yeah. Plus they'll want $5,000 for the program as well. Outlier equals 81% wins. It equals 81% amazing. All day, baby. Jumping off. See you later, Dave. I want to talk about New Trader, Rich Trader with you anyway. Hey, chapter 12. New traders hop from system to system the moment they suffer a loss. Rich traders stick to a winning system even when it's losing, and that can be tough, right? Take losses as feedback. Take losses as feedback. Some of us have to make money somewhere. So do we send that? Look, you can send that to me all day. You have to take losses as feedback, but that doesn't mean that what you've been doing is broken when you have a string of losses. Losses happen, but sit down, observe, and say, what happened to the stock individually, to yourself? Maybe there was some trading psychology lesson, to the market as a whole, maybe the sector, something you can glean information from, right? So it says, I currently utilize a trend trading system that uses stock indexes. The system is only adjusted in the first or last hour of the trading day, and only if I get a signal. So don't do a dang thing unless you get a signal. In my opinion, trend trading has proven to be the most effective way to trade. Disciplined traders can make money trading any system with an edge, but traders without discipline can't make money trading any system because they're unlikely to follow it. They'll try to judge signals instead of following them. They'll try to predict the market instead of following what the price and volume are telling them. Now, when he says trend trading has proven to be the most effective way to trade, you could do anything with trading, right? For example, let's just go to the SPY real quick. You could say that when the market's up, I'm going to go short. I was that guy, and it sucked. You could say when it pops over a moving average, I'm going to go long. When it pops under a moving average, I'm going to go short. Whatever, right? But trend trading is basically when the market's moving in a direction, when your stock is moving in the same direction, when the sector is moving in the same direction, that is where the trend is going, right? Don't fight the trend. Just get on your surfboard and ride the wave. Let's go to the next page. Find a style of trading you're interested in and feels right to you, and learn everything you can about that style. Develop a system that is historically profitable. Develop a watch list of stocks or ETFs that have the characteristics that will make them good candidates for your system. And test it on paper for a few months so you can actually have confidence in it, right? You got to believe what you're doing is going to work through different market cycles and see how it performs. So once you're convinced, once you believe that it's going to work, it's a winning system. Begin trading with small positions, just enough to be profitable and cover commissions. Slowly increase your position size as you start to understand all the moving parts of your system. Yorn, one of our regulars, he asked me one day, he had a deposit that he wanted to put in and start trading with it right away. And I said, Yorn, I wouldn't jump all the way in with that. And here's why. Let's say, for example, you get a $500,000 payday, right? Maybe some inheritance, maybe you sold your house, whatever. And you do plan to trade with that $500,000. I would suggest taking it slow, putting in 10% at a time, 20% at a time, trading with that for a month and getting a feel of what that feels like, right? You're going to be buying a lot bigger positions. And also, when you get those wins, they're going to be a lot bigger dollar amounts. But when you get those losses, they're also going to be a lot bigger dollar amounts. And if you go in and you go from 50,000 to 500,000, the wins are 10 times bigger, you're going to feel 10 times better. But when those losses are 10 times bigger, that's going to feel really bad, right? So whenever you start trading, I always tell people, layer it in, right? There's no rush. Once you get to your full size, you're going to be golden, but you need to adjust to that, right? So for example, I lost 60 pounds over the last couple of years. And when I look in the mirror today, I'm used to what this looks like, okay? But if I had gone from, 250 to 190 overnight, and I look in the mirror, I'd be like, whoa, this is crazy, right? And I may not know how to deal with that, right? I may be wearing the wrong size clothes. I may be eating too much or too little, right? I would need some time to adjust. And the same with your trading account. Don't go from 50 to 550 overnight without taking that time to adjust to your position size. Let's see what this says here. Journal your thoughts and feelings as you trade so you can learn what causes you to over or under trade or not follow your system. The winning percentage, I guess these are things you need to put in your journal. Pulled out a blank worksheet and explained each line new trader. Winning percentage, wins divided by total trades. Payoff ratio, largest winning trade, largest losing trade, average winning trade, largest drawdown, et cetera, et cetera. These are things that you can calculate if you're up to. Here's my personal trading methodology. I like trading systems with limited screen time. That sounds familiar. I prefer to make trading decisions in the first hour and last hour of the trading day and not waste time glued to the screen. I prefer using a system with end-of-day signals for entries instead of day trading. And it's like Steve wrote this, and I literally listened to every word he said. Often, the best exits lock in profits at the open, which I don't trade at the open because I don't want to deal with it twice a day. That frees up about 30 hours a week for backtest, chart studies, reading, enjoying life, maybe even having a job. I like systems that trade above the level of random price noise and look at the bigger picture and the long-term trend. I smile because I just identify with everything on here. I prefer to trade price action rather than attempting to make sense out of financial headlines or the opinions of others. I prefer simplicity over complexity. I've been profitable over the years using only moving averages, RSI, which I don't trade with, and price action to capture trends. like to limit risk exposure to only 10 to 20% position sizes in most. So position size is not the same as risk size. We've had that discussion before, right? A 5% risk size may be 15% of your position size, etc. You'd have to calculate that based on ATR and everything, but beyond the scope of this. But the point is that you're not putting 100% into anything. I'll take a bigger position in a diversified index. My favorite signals are oversold price levels extended far from the 10 EMA or near the 30 RSI. I like breakouts of price bases to all-time highs. Remember, we talked about how all-time highs are bullish. And a moving average crossover system with the 10 trading over the 50-day. 10 over the 50, right? It's one of the things we talk about. I don't have a portfolio of stocks. I have trades and trading systems. Exactly. I don't have a portfolio of stocks. I trade when there's something to trade, and I don't do anything when there's nothing to do. And I would definitely say the same would work for you. If you've been following along, we've been going through my notes from when I first read this on the Kindle ages ago on this incredible book called New Trader, Rich Trader. If you don't have it already, go grab it on Amazon. It's going to be the best $8 you ever spend. Top 5 trading books ever, in my opinion. So we're on chapter 13. New traders place trades based on opinions, where rich traders place trades based on probabilities. Now, I wanted to take a moment to talk about data, right? Before we go into anything in this chapter, I'm a huge data junkie. I keep such detailed records on my trades because I want to know if there's a way that I can improve those, if there's a way I can improve my probabilities, in fact. So here's my numbers for the year. We are at 11.19% in my actual real money portfolio, with the proven edge, which is not all that great, of 12 basis points, meaning every trade I put on average, I'm making 12 basis points on it, which is not huge. I'll tell you that. It's not. 52% win rate. But you'll notice that we figured something out later in the year, and I call that the master key. So when I only look at trades of these 85 where the master key was set up, that was 49 of those trades. And of those 49 trades, the proven edge is significantly higher, right? So 7.69 expectancy on this with a 69% win rate, which was higher. It absolutely was higher. And then we had the string of losses right here. And then November is going to be the first losing month since we figured out the master key, which that's part of trading, right? Annualized return is pointing at 107%. So I'm super stoked about trading this next year. But taking it one step further, last week we had those losers, and we found some commonalities in those losers, which was, of course, Google's going to sucker at the moment. Hang on. Oh, geez, hang on. Let me load that in. I don't know why it's all blank all of a sudden. Oh, I know, because I deleted it. That's why. Sorry, that was my bad. The commonality was that the trades were having moves greater than 5% leading up to the buy signal, which is the outlier move that we're looking for, right? So if it's having the outlier move before we get in. So what I did was I pulled the data and I said, you know what? If I only look at trades that were 4.99% leading up to the buy signal or less, that actually gives an 86% win rate with a proven edge of 11.89%. So nearly a 12% expectancy. So going from actual returns, 12 basis points, master key, 7.69%, and then master key plus that run up, which is just going to be included in our strategy from now on, to 11.89%. So, I mean, we're talking about expanding probabilities greatly, right? So I'm really stoked about that. I'm very, very excited to have all this data here. And I would not have been able to figure this out if I didn't have the data, if I didn't keep super deep records. Now, not everything that I do, I have really taken that much time, right? Because I've got my entry and exit signals on there. I've got the entry and exit heat maps on there. I've got the price where I open and close it. I got the options price. I got everything. And at different points in times, there will be an opportunity to say, hey, let me go back and take a look at this. What is there something I could learn from? So to this, rich traders place trades based on probabilities. Even if his trading method had a large winning percent, if he didn't control his risk, he could eventually lose his capital in the account, which is what happened to me years ago. 86% win rate and just continuously evaporating dollars out of my account because my losers were so much bigger than my winners. While I agree you must spend money wisely, and frugality is a great way to get your first trading account, I also believe it's important to enjoy the money you've earned and spend it on the things you think are important. While I couldn't care less about a new car or bigger house, I do like to spend my money on traveling and dining with friends. When you spend money, you need to ask yourself if you're getting the value from the money that you're spending. If you are, you should relax and enjoy it. If not, then don't spend your money in that way. Please relax. These are trading profits well spent. Oh, he's talking about taking his the new trader out to a nice steak dinner. You must understand that early in your trading career, your losses are the tuition you pay to learn how to trade. Someone in the chat said that the other day. It's no different than college tuition you would pay to learn any career. When I lose, I feel like a failure. Like I don't know what I'm doing, new trader said. That was a big thing for me personally. I really took it hard. Like, imagine your girlfriend breaking up with you on every trade, right? I would take it really hard. Where it's like, oh, I'm such a loser. But then I got pretty callous to the fact of losing. And it's just like, it happens, whatever, move on. Yeah, it sucks, but like, not a big deal. I positioned size correctly. I followed my plan and I can still survive. So there you go. Oh, Dave says, would love if you come up to 1080p. Easier to read your screens. Dave, I thought it was 1080p. I apologize about that. I'll get it there. Don't worry. It's just a setting and I can't do it while I'm live is what it says. If you follow your trading plan 100% from start to finish, then it's a successful trade. Hey, that's exactly what I just said. If you follow your trading plan from start to finish 100%, then it's a successful trade. If you make a mistake but learned a lesson from the trade, it was money well spent to improve your skills. 2 weeks ago, if you made a mistake, learned a lesson from the trade, it was money well spent to improve your skills. Mistakes that lose real money tend to be remembered and corrected way more than money lost in paper trading or simulators. Isn't that the truth? That's how professionals think about their work. They focus on the correct technique, and the profits come because of their hard work and diligence. Don't count your wins as they happen, because if you lose them, it will hurt even more. Focus instead on following your system. Take your signals as you get them, and the profits will follow. So that many times, turn off your P&L. Doesn't help you to see how much money or how much money you're winning or losing up on your screen, because you're only going to move when you get your signal. So if you see that you're losing money and it just hurts, right? You're giving yourself emotional drawdowns, I guess you could say, that you don't have to if you just turn off the P&L. First, you need to trade with the market trend. You have better odds if you're trading long in an uptrend and short in a downtrend. The best way to determine this is to look at the chart of the S&P 500 or NASDAQ. If price is above the 200-day, then you should be trading long. If the price is below the 200-day, you're in a downtrend. If the market's in an uptrend, you can go long based on your predetermined parameters. But you will lower your chance of success substantially by trying to trade long when the market's going down. When a torpedo hits a ship, the whole ship sinks, not just part of it. Oh, here's a note I left to myself. System notes. Opposite to how I've traded in the past and lost money. Ooh, I don't know what I was trying to say to myself. Grant says, you should send us all a 60-inch Black Friday 1080p monitor to watch you on. Those other companies send you a cheap laptop. Nah. How about I just send you some outlier stuff? A breakout could also be a long-term resistance point, like a 10, 20, or 50-day moving average, which a price finally rises above. On the flip side, if you're shorting a growth stock or the price goes under the 50-day, that's likely the place to look at going short, because it indicates that it doesn't have supportive buyers in this downtrend. In the stock market, opinions and feelings are wrong most of the time, but the current trend is right much of the time. Maximum volume flows to stocks and exchange into ETFs, which have the greatest potential for successful trading. Trade these equities. Trade only direction of the overall market trend. Let my system make all the trading decisions, not my opinions and feelings. Only buy at the sweet spot on the chart. Become an expert in the method and the stocks I trade in my watch list. Trade where the volume is, not in illiquid or liquid stocks or markets. Only price pays. I think I said that a couple days ago. In trading, emotions and egos are expensive collaborators. Our goal as traders is to capture price moves inside our time frame while limiting our drawdowns in capital. The longer I've traded, the more I have become an advocate of price action. Moving away from the perils of opinions and predictions has improved my mental well-being and bottom line. Rely on facts and price data rather than being tossed around by your own subjective feelings will ensure your long-term profitability. Absolutely. That'll work too. Absolutely. So to that point, everything we talk about in this is what we talk about on a daily basis, but it is so cool to see it in the text from my friend Steve Burns. So let's take the time now to switch gears over to New Trader, Rich Trader. So if you've been following along, we've been going through New Trader, Rich Trader chapter by chapter. As I mentioned earlier, this is one of my all-time top 5 trading books. Honestly, because it's easy to read, right? It focuses not just on the technicals, but also the trading psychology of it. And I would just recommend it to everybody. So these are my notes for when I first read it ages ago. I don't know when it was, but it's really fun to go back and revisit that. Chapter 14, new traders try to predict, rich traders follow what the market is telling them. Let the market tell you where it's going, right? What do you think the market will do today? I have no idea. If you ask me, that's what I'm going to say. I don't know. Which stocks do you like? The ones that go up. Are you long or short in the market? My system has me long. Do you think this uptrend will continue? I have no idea. This sounds exactly like talking to me. That's the funny part. Because I don't know how long these trends will last. I can only see what is presented to me. And so can you. Rich Trader gritted his teeth. Do you think the job report coming out this morning will be good or bad? And yet another attempt to get an opinion out of him. I don't know if a good report will cause the uptrend to continue or if it will have traders selling the news. I don't predict. I don't have an opinion, and I don't really know. Right? This is me. That's so funny. Like I tell you all the time, I don't follow the financial news. It doesn't matter to me, right? What matters to me is what the price is doing. What I do know is that following trends makes me money, and my system captures profits and trends and gets me out when it reverses. Man, is that cool or what? I didn't mean to change that color. Oh well. Oh, that's funny. I wrote to myself, I've been there, and it is terribly frustrating to have to listen to these kinds of questions. I said that. It's terribly frustrating to have to listen to these kinds of questions. This doesn't predict. It shows you the trend. You have better odds of going with the trend than trying to predict anything. Exactly. I read charts, I trade patterns, and I react to changes in the trends. Most importantly, I follow the market, and it tells me what to do. Golly. Follow the market and let it tell you what to do. Yeah. What I do believe is that traders can make money by consistently following the market's direction. The point of creating your trading system is to develop signals that tell you when a trend begins and when it ends. The signals used to determine a trend are price and volume. All other technical indicators are derivatives of these two, which is super true, right? In TrendSpider, there's like a million different, and you can even request new ones, different indicators here. But the majority of them, as he's saying, are based on price and volume and time. Peter asks, since we don't have all stocks from SPY and Outlier, can Outlier be accurate projecting a sell signal while the SPY is going up? For sure, dude. Like the best way to look at that is to go over to the performance summary. And you can see right here, Outlier with a 74% buy and hold. I'm sorry, 74% return. Buy and hold's at 89%. So buy and hold's outperforming. But keep in mind, the capital efficiency is at 1.53x. So 1.53x means that you are in the market 1.5 times less. So it's not 50% less. What would that be, like 75 basis points less? So 75% of the time. And you're getting approximately the same return, right? So you're in the market less, but you're getting approximately the same return. So your capital efficiency is greater than 1.0. If you were at 1.0, that means you'd be in the market 100% of the time and getting the exact same as buy and hold. But 1.5 means that you're actually doing 50% better in a way, if you want to think about it, with your capital efficiency. So that's a great metric to look at. And, remember, these are our long only signals. We do reverse engineer, we as in the trading room here, into short selling. But not the program, but the signals are long signals, right? So yeah, that performance summary right here on any stock is super useful. In fact, you can look at Tesla. Tesla's bonkers. Nvidia is also bonkers. Pull up Nvidia as well. All right, Tesla. By the way, if you haven't checked out these areas, these are so cool. All the stock news right here with the positive and neutrals and negatives, if there is a negative, those are so cool to me. And then the sector has the same news, negative all over the sector. And then the analyst ratings, man, this is really cool. Mahesh was really excited to add these, so I was excited to see that too. So Tesla's performance summary, 627% with a capital efficiency of 5.67, right? That's pretty crazy. And then Nvidia's, we'll do the math on that in just 2 seconds, Michael. Nvidia's is 1.72 on capital efficiency. Outlier is at 1700% returns. So let's go over to Tesla here, and I'll show you how to calculate that, Michael. So it says 5.67% or 5.67x. Now, there is a chance I get the numbers backwards, and I might have to massage my formulas to get it to work right, but we should be good. So the outlier is at 627.45%. And buy and hold is at 225.15%. Okay. So then capital efficiency, the way that we calculate that is time in the market. So time in the market is 49%. So if I do this correctly, we should get to that capital efficiency of 5.67. So 49%, meaning you're not in the market 51% of the time. You're only in the market 49% of the time following buy and sell signals here. So if I do this correctly, this divided by this, I didn't do that right. This divided by this, 4.59. Or was it? Hang on. I did the math on this last time. I did an example. I did it perfect the first time. I couldn't believe it. So it's, what is that delta? So this divided by this. No. Oh, nah, I don't know. I can't remember the math off the top of my head, but it has to do with the number of time or how much time you're in the market and then the comparison between the signal returns. So yes, the higher the better. Mark's going to kill me for not remembering that formula. Okay, let's get back over to here. The tools I work with are price, volume, charts, and moving averages. Sometimes looking for extended price trends using RSI. I don't use RSI, but you could. The price and volume of stock reveal investor and trader behavior. Human behavior never changes. Now, that is actually one of the key points of Outlier, right? Is getting that investor behavior component and putting numbers to that, right? It creates a pattern you can observe. Greed and fear come into play and carry trends far beyond where rational, fundamental valuations could take them. The market's going to go where the votes carry it. Your job is to vote with the majority. I agree, right? I would say slightly different terms, right? It's more of like the ocean, right? If the tide is coming in and you've got the waves pushing the tide in, you should be riding on those waves rather than trying to paddle against the waves, right? You go a lot farther riding in the waves than pushing out against the waves. If someone thinks they can predict the things often enough to create an edge, it's the height of arrogance or ignorance. The only thing we can do with any certainty is to follow price action wherever it leads. We can learn how the market reacts by studying historical data, chart patterns, and trends. We can study how human greed, fear, and ego affect price movements and that knowledge to our advantage. New Trader, Rich Trader. We are 15 chapters deep at this point, if you can believe that. So of these 15 chapters, do me a favor in the chat, type in a number 4 if this has been useful to you. I would actually really like to know that. This is a vote. Type in a number 4 if this has been useful to you. If not, type in the letter R, right? This is our vote, right? Number 4 or letter R. Let me know if this is useful, because I want to make sure that I'm not wasting your time and I'm actually like helping you, right? So let's go to this. Chapter 15. New traders trade against the trend. Trend traders follow the market trends. I have the best story for this. So when, I can't remember what year it was. My son was probably 3, maybe 2015, maybe 2016. My son and I were at the library, public library, and these particular traders that I was following at the time, they had said, in fact, I mentioned it yesterday, whenever you see the market up, sell calls against it. Whenever you see the market down, sell puts against it, right? Completely opposite of what you should be doing. And at the time, QQQ was hitting new all-time highs. And so I'm at the library, and the only reason I put the trade on is because I saw it hit new all-time highs. I was like, sweet, I'm gonna sell calls against this. And that was one of the worst trades I could ever put on, right? It was like the moment that I put that on, Qs were going up like hand over fist day after day. That was when Apple couldn't go down. And I look back at that trade and I'm like, what did I even do that for? I didn't have a reason to, other than the market was up. And so I was just like, I'm going to go against the trend. Number 1 rule in trading, don't be a contrarian. You've probably heard the phrase contrarian trading many times. I'm here to tell you, contrarian trading is bankrupt trading. I've done it. There's no reason to be a contrarian, right? If there's a speeding train moving down the tracks at you, do you actually want to step in front of it and say, hold up, I know better than you, you need to turn around? Or do you want to step aside and as it goes by, grab that handle and ride that train all the way to Atlanta? I mean, you tell me. Do you want to get steamrolled by the train, or do you want to be on the train when it's going? Contrarian trading is standing on the tracks, putting your hand up and saying, train, you've got to stop. That is quite enough. You need to turn right around right now because I said so. One of the most stupid things you could do as a trader. All right, we're seeing some 4s in here. That's what I want to see. Thank you, guys. Contrarian trading is the toughest. It's the easiest to go bankrupt with, I'll tell you that. So rich traders follow the trend. When studying charts, he saw more trends over the long term and more range-bound charts in the short term. Interesting note. He can now identify uptrends as stocks with the current price above a 50-day and downtrends because the current price was under the 200-day. It was so obvious to him that when the market was in an uptrend, most stocks were in an uptrend. So obvious. Now, I remember having that conversation with Steve. This is one of the best conversations because I was so ignorant at the time. I was on Skype with Steve, and he said, Chris, is the market or is the stock trending up or is it trending down? And I said, I don't know. How do you know? And he said, well, you add a trend line. And I'm like, well, how do I add a trend line? That's how rudimentary it was for me, right? So where you are today, trust me, I've been there. How do you add a trend line, Steve? Add in the 10 EMA. Okay. So I added the 10 EMA. What does that tell me, Steve? When it's above the 10 EMA, that's an upward trend, right? When it's above or below the 10 EMA, that's a downward trend. Now, as you know, trends don't last forever. And that's why we have those confluence of the 10 being the short term, 20 being intermediate term, 50 being long term, right? When your short and intermediate term cross and price is under your long term, that's a downward trend. Does that make sense, right? Having that short, intermediate, and long-term moving average all working in the same chart like this gives you so much more information. So yeah, I've been there. Trust me. Like as basic as you could possibly go with stocks, I was there. Okay, so what are the best ways to identify and trade trends? That's a good question. You search for increasing volume. You look for the highest volume stocks and ETFs. As you know, volume is a key thing for me. Look for new highs and new lows. You'd like to find a stock that has been in a tight price range for a few months, like between 95 and 100, that suddenly breaks out to a new all-time high. As I've said, that's a bullish thing, of 101 on twice the average daily volume. That's a Minervini thing right there. That's a trend right from the start. Sellers are no longer willing to give up their stock at 100, and buyers are willing to pay 101 because they think it will go up and they'll make money. Trend traders don't care why it's going up, which is what I say all the time. I don't care about the news. All I do is follow price, and you should too. They only care that it's happening. Trend traders are not bullish or bearish. They don't care which direction the market is moving, only that it's moving. The trend trader system would have been just as likely to sell the same stock short at 94 as you would to go long at 101. It's so refreshing to see exactly how trading is done, written in black and white. A trend trader needs only to catch a large piece of the price movement inside a trend to make money. A counter trend trader has the odds stacked against them because they have to pick big reversals at the top or bottom to be successful. And it is almost impossible to pick that reversal. Almost impossible. Note here. Literally, the worst trades I ever made were trying to outsmart and get in front of a moving trend rather than trading with it. I wrote that to myself at one point. I wish it would say the date. That would be so interesting. Literally the worst trades I ever made were trying to outsmart it and get in front of a moving trend rather than trading with it. That is interesting to see. Young Chris with better eyesight, more hair, less wrinkles. Yeah. Time doesn't wait for me or you or anyone else. Do I have to buy a new high as a trend trader? No, of course not. You can establish that the stocks on your watch list are in an uptrend. You can also buy on pullbacks to create better risk-return ratios. You can measure pullbacks by looking at charts for support. Your stock may have a support at the 10-day or the 20-day over the last 2 months. You can verify the price as found support at the 20-day, and then it goes back up. So this is a good example of that, right? Let's say, for example, now I don't trade this way. I would rather trade breakouts versus pullbacks because a pullback can be bearish, right? The SPY found support on the 20-day right here. And that may be a strategy that you would want to employ, right? You see it close right at the 20-day, then close back over and has bounced significantly since then. A great strategy here for that one. So if you see, and I'm just eyeballing this, right? This is not a trade recommendation, right? If you see a pullback on the SPY down to, under the 10, above the 20, that could be a buying opportunity, right? Doesn't mean every trade's going to work out, right? Because, look right here, right? And if you were keeping your risk tight, you would have got out. That was the election. So not exactly how I trade, but it could be great for you. Why am I the only one that clicked the thumbs up? Damn it, Randy. You're right. Why are you the only one? Let's go, people. In a strong uptrend, the 10 and 20-day moving averages may not be touched by the price for weeks. For weeks. That's a good example right now. The 10 and 20-day, I don't know when they're going to be touched, right? So if you're waiting for that pullback, it could be $100 higher before you get that pullback. The moving averages will trend higher in uptrends. So if you're only using the moving average as your signal, you'll make a profit when your stop is triggered because the price at which you sell is much larger than your buy price. So meaning, if you bought in when it closed over the 50 EMA here on September 10th, it was roughly 547. The next time it closed under the 50 EMA was here on October 31st at 568. So that's a $20 move on the SPY if you just followed the one moving average, the 50-period moving average, right? So, of course, make different types of trades that fit your personality, right? I'm not saying that this is the only way to trade, but there's lots of different ways to trade. Additionally, price moving above the long-term moving averages, like the 200 and 250, can be used to signal the beginning of a new uptrend breaking out of a downtrend. These systems create some of the best risk-reward ratios and are used to signal the end of a downtrend or bear market and the potential for a new uptrend or bull market. A good way to lose money is to go short in a bull market or long in a bear market. That is a good way to lose money. The probabilities are stacked against you. It is arrogant to think that you can call tops, call bottoms, and market reversals based on predictions. All decisions must be based on quantified signals that show the potential of capturing a trend. Steve, oh my gosh, working with him directly, he was always about the word quantified. Oh man, that's funny to see that there. The only thing traders should attempt to do is measure the direction of the market, how to trade it effectively, and where to cut their losses when it reverses. All right, note to Chris. What did I say? Arg, that was me. I wrote that. Arg, that was me. A good way to lose money is to go short in a bull market and long in a bear market. The probabilities are stacked against you. The best trend traders win between 40 and 60% of the time. They're successful because they win big and they lose small. And you can even make that like, you can even expand that out, right? Let's say you got a 70% win rate and you still lose small. I mean, you could see like buckets of money, right? My particular returns, my wins and losses are roughly the same size, a little bit bigger on the wins than on the losses, but my win rate is close to 80% at this point. So it's very profitable, right? So you don't have to have those giant wins if you can have multiple wins. I trade a system that is purely technical, based on past performance. My system only depends on the trend itself, not my opinions or news stories. I don't trade off fundamentals or earnings expectations. I trade based on other traders' participation in the market, as is illustrated through their buying and selling. I don't predict the trend, I follow the trend. I measure the trend through volume, price, and moving averages. Trading is rocket science. You find a rocket and you ride it. I love that. Trading is rocket science. You get on a rocket and you ride it to the moon. Quantified trading signals can be based on different yet equally profitable strategies. Momentum signals are based on buying strength. Momentum traders wait for a strong move in the stock and then buy and hold a position for a short time if it continues to move in their favor. That's this guy, momentum trader for sure. Breakout signals are based on buying all-time highs, 52-week highs, or moving through resistance and trying to buy high or sell higher, trying to buy high and sell higher. Breakouts are bought to catch a strong and fast-moving stock. Buying a long-term price support level or an oversold oscillator like the RSI attempts to create a good risk-to-return ratio based on buying deep dip in the market or stock that is in historical uptrend. Finally, trend-following signals attempt to move in the direction of the long-term trend by the path of least resistance. Jesse Livermore, one of my trading heroes. There's only one side of the market, not the bull side or the bear side, but the right side. It took me longer to get that general principle fixed firmly in my mind than it did most of the more technical phases of the game of stock market speculation. There is a very good book called Reminiscences of a Stock Operator by Edwin Lefebvre. It's like Brett Favre, right? It's spelled weird. But Edwin Lefebvre, and it's supposed to be based on Jesse Livermore. That is a fantastic book. Reminiscences of a Stock Operator. So add that to your reading list. That is one that's worth your money there, Mikey Mike. So that's going to wrap it for today. Let's transition over to New Trader, Rich Trader. We're in chapter 16 already, if you can believe that. If you haven't been following along, go grab your copy of this on Amazon. It's going to cost you like $8. Definitely one of the best $8 you'll ever spend. One of my top 5 trading books of all time. And these highlights, these notes in here are from the first time I read this. I don't know when it was, ages ago on Kindle, and it just happened to stick. So I think this is pretty cool. New traders follow their emotions, which put them at a disadvantage. Rich traders follow systems that give them an advantage. Now, I want to talk about a story Peter and I were chatting about on Discord. And he mentioned he could really see some improvements in his trades because he was making decisions based on his P&L. And just yesterday and the day before, I've been mentioning how much of a big deal it is to turn off your P&L. That's something Steve told me ages ago. He's like, turn off your P&L. Doesn't matter. Focus on your entry and exit signals and don't do anything unless you get an entry or an exit signal. And so I had mentioned that, and Peter relayed to me yesterday that he did that, and his trading has improved tremendously already. Right? There's a psychological aspect, an emotional aspect to seeing the dollars on the screen, right? Because I forget what it was, but it's like Mark mentioned it this morning in a meeting we were having. What do you call that? Some sort of fallacy. Either way, but it's like you win $100 and it feels like, hey, I won $100. You lose $100 and it feels like you lost $200, right? It's because the losses hurt more than the wins, and we are much more likely to take those small wins off the table and let our bigger losses run, hoping that they'll come back. But if you just focus on your signals, then it's just all noise, right? Because you're only waiting for those signals to move. All right, he new trader created a list for characteristics he was looking for. Stocks were within 5% of their all-time highs, over 5 million average daily shares. They all had new products or business models. Each had earnings increases or sales increases. And all the companies were expected to grow in sales and profits. So basically, strong companies. This is it. This is what I've been waiting for. All the stocks were in established uptrends with prices all above key moving averages like the 10, 20, and 50 day. I told you this is the book where I got specifically the 10, 20, 50 rule that I use. There it is. I've been waiting for that. That's actually been what I was most excited to come across. Right there, the 10, 20, 50 day. None of the stocks had lost their 50 day over the last 6 weeks. Typically stayed above the 20 day, touching only on minor retracements. Stocks spent 80% of their time above the 10 day, going to new high prices right around the last 2 earnings announcements. He set up some Bollinger Bands, which I don't use. You notice that many of the stocks in downtrends bounced off the Bollinger Bands. On those charts, the 10 day was below the 20 day, which was also below the 50 day. The stocks that had really crashed were also below their 200 day. There it is. Finally, I came across the 10, 20, 50 rule. I knew it was in here. So let's jump into these charts real quick. I don't know if I can zoom in. All right. It says he studied stocks and uptrends, right? So you've got, this is Amazon 2017, right? Moving up. You've got Facebook moving up. You can see how the moving averages are all stacked. And then you see something like this, like Google, right? That's an outlier move that we're looking for every day, where you've got your moving averages that have all crossed over and then kapow, moving higher. And then you've got Apple right here in this trend. And you study charts and downtrends, right? You got the 10, 20, 50 pointing down. I mean, when I learned that 10, 20, 50 rule, it's like so easy. Which direction are the stocks going? Up or down? Well, just look at the 10, 20, 50. Makes it easy. And then this one, and you can see here, the longer term and the shorter term looks like the 50 and the 200 and how they crossed. You got Groupon. Right, beautiful uptrend, but those uptrends don't last forever. And that's why I say if your 10 moving average breaks, that's your, let me get my cheat sheet real quick. Your 10 moving average is the strong momentum, indicator of the short-term trend. If your 10 breaks, then your short-term trend is down. And, then you add in the longer terms. All right, let's get back out of that. New trader only wanted to trade stocks that had charts with solid, stable uptrends in price, and he decided it would be too stressful to trade stocks that had large daily price swings. Stocks with big ATRs, large daily price swings, you can quantify these numbers, right? And maybe you say like, oh, I don't want to trade anything with the ATR over 5, right? If that works for you, then trade around that. Or you can adjust your position size, right? The bigger the ATR value is, the smaller position size you should take because the bigger those swings are. Volatility was not going to be his friend in a trend trading system. He knew it would cause false stop losses to be triggered when the stock briefly broke below support, and early profit taking when the price would momentarily reverse below a trailing stop. A volatile stock could lose its 10-day moving average one day and be back over it the next day. You see it all the time. Saw an opportunity to buy stocks in his watch list at the 10-day moving average when it was breached and didn't recover before the close. Meaning, right, when it closes over, essentially is what he's trying to say. Hey, Michael. So he's saying when it crossed over the 10 and closed there, that's when he would buy. He would buy stocks on his watch list as they trade up through the 10 EMA or bounced off as support. After he made the buy, he would set a stop loss 5% below his purchase, and he would only risk 1% of his trading account with a 20% position size and his total trading capital. So this is something we need to, or we've tried to break down in the past, right? He's using 20% of his account. So round numbers, let's say at $10,000, he's using $2,000 on this one trade. But because he has a 5% stop loss on the trade, then he's only risking 1% of his account. I did the math correctly on that. So let's do some math on that. All right, let's say that we had our $10,000 account and we're using 20% of it, right? And let's say that it was a $100 stock. So we're giving it till 95. So equals $2,000 divided by $100 per share, $20, right? 20 shares. So if it goes from 100 to 95, that's a $5 loss times 20 shares. 100 minus 95 times 20 is $100. Look at that. That's 1% of his 10,000. The math checks out. So you can trade big position sizes. Absolutely. But the bigger you size, the smaller amount you should risk on that particular stock, right? So in this case, he's talking 5% pullback. I mean, you could do 3% pullback, right? You're basically making the... I heard somebody say it like this one time. They're saying, you're paying this amount to find out if it's going to work. In this case, he's paying $100 to see if it's going to work. If it doesn't work, then he's just out $100, right? It's kind of like buying a scratch-off lottery ticket, I guess you could say. He just bought a $100 scratch-off lottery ticket, and he's looking at it, and he said, you know what? I'm willing to invest $100 into this, and if it works, cool. If it doesn't work, that's fine too, because I knew the risk ahead of time. But if it does work, maybe he can make back the 100 or more. Once his buy was correct and his stock started trending 5% above the 10-day moving average, he'd set a stop at the current 10-day moving average, moving it up or down as needed. The popular moving average would be his trailing stop to lock in profits. This system was based on taking profits when the uptrend ended. It played it safe, getting out before any large losses could accrue after the loss of key support levels. To limit risk, it would be important to keep his position size at 20% of his account. The stop loss is at the 10-day moving average. He would only trade the system when the S&P was above. So he'd only trade the system when the S&P was above the 10-day moving average and the 20-day moving average, and the price. I'm sorry, I did it wrong. When the S&P had the 10-day moving average over the 20-day moving average, and price of the S&P above the 50-day moving average. There it is. The market needed to be in an overall uptrend and bullish for his system to be consistently profitable. He believed this rule would increase his odds substantially. Randy, 5% is a bit too tight for me. It was getting stopped out too often, and then the stock would take off. Dude, yeah. We've all been there, right? And that's one of the reasons why I modified my exit rules specifically on that topic for the close below the prior day's low after I've already rolled it, right? Because you can get into a situation where the stock's just like barely moving here or there, or maybe it even closes down a little bit, not even all that much, but it's below the prior day's low. And then it turns around and goes without you, right? I ran into that plenty of times. So that's why my one and only stop loss is now the half ATR from entry. Which, you know what, Randy, that may be too tight for you even. I don't know. Don't trade someone else's system. And this is why I always say this is how my style of trading, you need to build your own. Customize it to fit the principles you've studied and those that you believe in. Your system must match your own risk tolerance and return expectations. Be wary of straying from your trading plan because a mistake that wipes out your profits can impede your ability to trade going forward and take a toll on your confidence. Don't let fear and greed make you do something destructive. Always stick to your plan. Quint Tatro, quote, "The sooner you realize you're trading against other traders and not just the stocks or the market, the better off you'll be." So, yeah, great lesson today. Basically, 10, 20, 50. So good to see it in black and white. I knew it was in here somewhere. But of course, you've got to follow your own system. Figure out what is working for you. Because my style, while it works for me, may not work for someone else. And I'll be the first to say that it may not, right? New Trader, Rich Trader. We've been going through this. This is one of my top 5 trading books of all time. And the Kindle version of this I read a million years ago, and I highlighted it as I went through it. And it's actually really awesome to go through and see some of the highlights that I made ages ago. So let's go through this. We're on chapter 17 today. New traders don't know when to cut losses or lock in gains. Rich traders have an exit plan. Going back to that video, right? That's specifically what I was talking about, written in one sentence, right? When she was talking about you can diversify and have one stock just totally crash and burn and go to hell. It's like, what? How about you just have a plan to lock in your gains with an exit plan, with an exit signal, rather than just like not knowing, right? New traders don't know when to cut losses or lock in gains. So this is talking about new trader. He knew that if he had to cut a loss, it was because the market was not conducive to his system at that time. He wasn't wrong. There was no reason to take it personally. If you followed his trading plan and had to take a loss, it's the cost of doing business. I struggled with this for a long time. I struggled a lot with losers, right? I would get down on myself thinking I was the loser, right? That's probably some like deep-seated childhood trauma or something that I need to work out. But when I would have losing trades, I felt like I personally was the loser. It sucked, right? That doesn't mean you're a loser. It just means that the market isn't working with your strategy right now. You can do a couple things. Number one, you can push harder when the market's not working for you. Or number two, you can take a step back, evaluate, learn from it, maybe go back in, or maybe realize I need to sit out for a while, right? Just don't take it personal. Success at anything in life requires controlling risk, the right mindset, a successful method, supply and demand, right? A market, discipline, courage, limiting losses, and letting winners run. In business, there are methods that can bring in customers and turn a profit, and others can run off customers and lose money. Trading is similar, and methods that turn a consistent long-term profit are essential for success. The best ways to manage stress are to only enter situations that you feel comfortable and knowledgeable about. Kind of going back to what I was talking about with a new strategy, right? Or just like relying on a passive investment, right? I don't feel comfortable with those. I'm not knowledgeable about them. I don't know what they're doing. I don't know how they're limiting risk. So I wouldn't be interested in taking those. Progress slowly, only taking on additional risk and responsibility when you're sure you're ready. Another reason why I say when you start out, start with a small account, get used to that, and then add in funds, right? Maybe 10% more per month, or maybe let's say if you got 100 grand to put in, maybe 10% at a time, so you get used to those sizes, right? Taking on additional risk when you're ready, when you're sure you're ready. Patience can pay big dividends in life. Patience is not inaction. It's knowing what you're looking for and acting at the right time. Yep. In fact, one of my favorite quotes from one of my trading heroes turned into my friend and mentors is Mark Minervini. Wait in cash for proper setups. How long? As long as it takes. Like, there's no reason to rush into anything. Just wait for your setups. Patience is not inaction. It's knowing what you're looking for and acting at the right time. In life, as in trading, people with a written plan accomplish more than people without a plan, no doubt. And reviewing that plan, right? It's only so much to have a plan, but it's something different to actually work through the plan. Go step by step through your plan, right? Working the plan. That's the important part here. It's so much to have a plan, but to actually work the plan. Before you make any decision in life, you should ask the question, what do I have to lose? This should precede, what do I have to gain? If the answer is I could lose 100, but if I'm right, I could gain 500. And my odds of being right are 50%. That's a good risk return profile. If it's reversed, you have a bad risk return scenario and you should pass. This also applies to life in general. Now, personal story. When I was trading ages ago, a different style of trading where I sold calls, sold puts. Basically, it was risking 500 to make 100, which is the exact opposite of this, right? A $5 wide, let's round it, $6 wide spread, you would risk $500 to make 100 on an option spread. I'm not going to teach you that because I don't want you to know that. I went through that. I was convinced that selling calls, selling puts, selling spreads, whatever, was the way to go. And I got real fancy with it. But when I was wrong and I lost the $500, it didn't make up for the fact that I needed now 5 more perfect trades in a row to make up for the one loss. It was never mathematically going to work out. And honestly, I'm glad that I did it, but I wish that I had what we have now, in 2009. Then I committed the deadly sin of a trader. I hoped it would get back to even. This was the worst trade I ever made. Hang on. Let's read the story here. My first year of trading, I planned to get out of a trade with a $100 loss. I thought I was lucky because I didn't take a loss on a couple of occasions. You've been there. I know you have, right? Where you didn't take your loss. As Minervini would show in this graphic here, right? Knowing you should get out when it gets to here, but being afraid it's going to do this. But what happens is you get caught in this move, right? We've been there. I know you have. I've been there. I watched a $115 loss get back to even, and then turn a $150 loss into a $100 profit. So this emboldened me. As it turned out, I wasn't lucky. I was unlucky because it took me longer to tame my ego and discipline myself to take the first loss. It was difficult to keep myself from thinking that I would get lucky again. The next time I was down $100, I abandoned my plan. You've been there. I've been there. Thinking that I was smart enough to read the price and volume action in real time. Any young trader in that situation is only going to see what he wants to see. I didn't want to take the loss. Then I didn't want to be wrong about not taking it. Then I committed the deadly sin of a trader. I hoped it would get back to even. This was the worst trade I ever made. I turned what should have been a trade of a few days for a $300 profit into a week-long ordeal that turned a $100 loss into a $500 loss. Just as bad as the monetary loss was the ridiculous amount of time I wasted glued to every tick. I rode an emotional roller coaster for a week, and it was completely unnecessary. That experience taught me to honor my stops when they were hit the first time. The first planned stop loss is the best one to follow. Peter says, some of the best trading days are the days we don't trade. Dude, yeah. A loss never bothers me after I take it. I forget it overnight. Oh, this is from Jesse Livermore. This is I know this quote. This is from the Reminiscences of a Stock Operator, an incredible book. A loss never bothers me after I take it. I forget it overnight. But being wrong, not taking a loss, that is what does damage to the pocketbook and to the soul. Always have a reason to get into a trade and a reason to get out of one. Having a trading plan gives you an edge over the traders that rely on emotion, predictions, and opinions to make decisions. When you get trapped in a losing trade, it's usually an emotional mistake rather than one of intelligence. It can be difficult for a trader to learn to lose. That was hard. But you must accept the loss and move on. The smaller you keep your trades at the beginning, the easier it will be to accept a losing trade and exit. Man, it's like this dude and I like know each other. The larger the amount of money you will lose on the exit, the more a trade can be influenced by ego, stress, and destructive emotions. So the takeaway here is really having that plan, creating the plan and working. And that plan needs to be your own, right? I go through my plan every day, but it's not your plan, right? It's worked for me. It's something I've developed for years. And I've worked with incredible traders that have helped me develop this. And we have the data with Outlier to help as well. But that doesn't mean it's right for you. And I really want to stress that, right? Maybe instead of buying options, you buy stocks. Maybe instead of buying the I don't know. You can come up with all kinds of different strategies out there. And we want you to. Right? You don't have to follow my particular strategy. But you absolutely should use the Outlier data to come up with whatever strategy you do come up with. So, last chapter, if you can believe it, of New Trader, Rich Trader. We have gone through this entire book. Now, before I get into this, let me know in the chat, what do you think of the book? Have you got a copy of the book? Are you using anything from the book? What's your biggest lesson from the book, right? Just let me know what you think of the book. And then on Monday, like I say, the author himself, Steve Burns, will be here in the trading room to join us and chat. I'm so stoked about that. New traders cut profits short and let losses run. Rich traders let profits run and cut losses short. This right there, new traders cut profits short and let losses run. Rich traders let profits run and cut losses short is, in my opinion, the definition of why 90% of traders lose 90% of their accounts in the first 90 days of trading. Of course, it makes sense, right? When you see that $100 win in your account, you're like, oh, snap, I made some money. Let me get it real quick, right? Other than the fact that you should have turned off your P&L, but even if you kept it on, you look at it and you're like, oh, I could really use 100 extra bucks right now. Maybe I should take that. But on the other end of it, you see the $100 loss and you're like, man, whatever, it'll come back, right? It'll come back. And then it turns into 200 and then 500 and 1,000. You're like, oh my God, I should have took that $100 loss, right? Now, I'll also say that there are trading teachers out there who I fell into their trap before I met Steve. And I traded with them for years. And their whole shtick was selling calls, selling options, selling calls when the market's up, selling puts when the market's down, because it's always going to bounce back, right? It's always going to return to the mean was their thing. And their thing was sell a call. If it's not working for you, just roll it out in the future. Just continue to roll it into the future, right? Imagine having sold calls on the SPY at any time in history. I can't imagine a time when you would have been profitable selling calls on SPY, because it's like, it was up like some 30-something% over the course of a year, which is like bonkers. But looking at this, right, it's like, so you're telling me that if I put on a bearish trade by selling a call, that if it doesn't work, I can just hold it indefinitely, hold it forever, right? Oh yeah, there we go. Okay. So I'm going to hold it forever and it might come back one day. Oh, that's awesome. But in the meantime, I have to put up $22,000 in capital. Cool. Yeah. $22,000 in risk, in risk. $22,000 in capital that I can't trade with on other things. Okay, cool. That's for one contract, by the way. $22,000, and I get to make $100. This is sick, man. What a great! I don't know if my sarcasm's coming through. This is so sick. I can make $100. I only have to put up $22,000 in capital, and if I'm wrong, I just get to hold it forever, and then maybe I might make that $100 back if the market ever comes down. Oh, this sign me up. I don't know why, but they got me. I traded like that for years. And they literally would go on their YouTube channel all the time and be like, let your losers run because they will come back. Pardon my language. I would have so many extra zeros on my account right now if I'd met Steve before learning from them. Randy says, it's probably the most important sentence in the book. Yeah, no joke. Mikey Mike, I like it. It's a great book. I'm anxious to start trading. And he's heard a rumor about a new platform. Okay. I don't know when Mahesh is going to let me tell y'all, but I'm going to put it this way. January 1st, I will be using a new platform to trade with. Just so you know. I may not make an announcement around that, but on January 1st, I will have a new platform to trade with. My plan actually is to use a paper trading account to show live on the screen every day. And then we can talk about position sizing and we can follow the balance as it grows, right? I'm really stoked about that. And then I can still trade on my business account on the other screen, which I think is going to be great. So there will be a new platform that I trade with starting on January 1st. If the announcement hasn't been made by then, I'm not going to make it a big deal, but you'll notice. You'll notice. Randy, I used to sell a lot of covered calls. Then I realized I was constantly capping my gains. Yeah. So absolutely. Especially in like a fast moving stock, right? If you get into a boring stock, that's really not going much of anywhere anytime soon, and you sell a call, we're going to get real deep for a second. You sell a call like a 30 delta call out of the money. I mean, 7 out of 10 times, you're not going to lose any appreciable gains because it's most likely not going to get to that point. But 3 out of 10 times, you may be really fighting tooth and nail, pissing mad because, oh man, I just lost out on a 15% move trying to capture that call premium for the month. Yeah, I get that. I also think your system will take you safely to cash in major market retracements. We've already seen that, right? When big pullbacks happen, being in cash already and not stressing when the market's falling apart, people freaking out. This is a good plan to limit big losses if you're on the wrong side of the market during a correction. Let's see. It sounds like new trader's making his thing, making his point here. I sold the big winner at $30 when it pulled back to the 10-day moving average on the chart. It pulled back to 30 after a runaway trend. It ran up before the company's earnings, announced as high as 33.50. My system had me sell the stock and take profits before the announcement, and it fell back to 25 after the earnings were announced. Look at that. His system had him sell the stock and take profits before the announcement, right? Now, do you have a system? Why did I close this? Do you have a system that talks about what to do around earnings? You should, right? For me, is the trade already profitable? If yes, does the expected move break the trend line I'm following? If no, hold through earnings. Now, we've talked about expected moves, and you calculate that with the options prices. But you need to have a system, right? I had much better risk-adjusted returns playing the expectations of earnings leading up to the announcement than I did holding through earnings. Huh. Mahesh and I were talking about that on NVIDIA. Because you remember not long ago, I was talking, Mahesh was wanting to buy a call and a put on NVIDIA, which, what's NVIDIA done since then? Gone sideways. So that would have been a hard trade, a really hard trade. He would have lost all of it. That would have sucked. But going back to this, yeah, I love buying a stock into earnings, right? I don't want to hold into earnings, like the earnings announcement, if I don't have to. But running up into earnings, yeah, you could do awesome with that. I've done it plenty of times. It was like the Wild West after an earnings announcement and very unpredictable. Yeah. If you like, it's up to you, but some traders don't ever like to go short. They would rather buy stocks that are uptrends in bear markets like gold miners, oil stocks, consumer staples, energy stocks, discount stores, or just stay in cash and wait. A short can only go to zero and give you 100% return. On the long side, a stock can double, triple, or more. The asymmetry favors the long side for returns because the long-term trend of the market is up. This is the final page of New Trader Rich Trader. My golden rules of trading. Don't lose more than 1 to 2% of your trading account in a single trade. Totally agree, right? Sometimes it happens, right? Myself included, right? I think on that last set of losers that we had, I think I had a couple that were like 3.5%. Sometimes that happens. No big deal. The deal is making sure you follow your signals. Don't trade something you don't understand 100%. Trade in the direction of the trend in the trading time frame. Meaning, if your time frame is on the daily charts like mine, and yours may not be, then I'm only going to be looking in the trend on the daily charts, right? I'm not so concerned about intraday movements. I'm really not concerned at all about intraday movements. I'm not concerned about the 5 minute chart. And I'm really not all that concerned about like a monthly or a weekly chart. If the daily chart's lining up, that's what I'm interested in. Only look for high risk return, or low risk, high return trades or high probability setups. Trade your plan, your systems, your signals, your chart, price action, everything except your opinions, bias, or predictions. Trade the correct methodology that fits your personality. Don't trade unless you have a plan with rules on entries, exits, and risk management. And I can't stress that particular sentence enough. Don't trade unless it meets your entry or exit criteria. Hey there, traders. Welcome back to a very special edition of Outlier Live, where I completely botched the intro. But what I was saying was an incredible friend of mine who I reached out to, it feels like a million years ago, to teach me how to trade. And I'm so stoked to be able to have him on the show today. Author of New Trader, Rich Trader, social media expert here. When I say social media expert, dude has over 600,000 followers, so he definitely knows how to teach people how to trade, and a ton of people want to listen to him as well. So thank you so much for your time and being a little patient with me. Here's our friend, the one and only Steve Burns. Steve, thank you so much for your time to come on today.
Hey, Chris. Glad to catch up with you, and been a long time. Thanks for having me on.
Yeah, I when I was trading and just losing money hand over fist, Steve was one of the people that I reached out to because I was thinking to myself, if I'm going to learn to trade, I'm not going to learn how to trade from somebody who teaches theory. I want to learn to trade from somebody who's actually done it. And I reached out to several people, and Steve was super awesome in being able to help me out in lots of different ways. And I think it's really funny to think about how the very first time that Steve and I started working together, I'll never forget because it was in the upstairs room of extra room in our house, and I didn't even know what a moving average was. I didn't know what a trend was, and Steve asked me. He said, "Well, Chris, is the stock trending up or is it down?" And I said, "I don't know, Steve. How do you know?" And he's like, "Well, you just add a moving average, and if it's above the moving average, then it's trending up. If it's below the moving average, then it's trending down." That is how rudimentary it was when I first started. And I am so grateful that somebody had that kind of patience to work with somebody as ignorant as I was at that time. So, Steve, really appreciate you doing that. Now, Steve has written tons of books. Steve, how many books have you written at this point?
Over 20, but I've lost count.
He's written so many books, he's lost count. I'll tell you what, one of my top 5 all-time trading books is New Trader, Rich Trader. In fact, I should have grabbed this earlier, but another one of mine that you helped with is, as you see, this is the library. Um, where's it at? Is this one here, How I Made $2 Million in the Stock Market. Now, this one's really cool because this is a almost like a historical documentary that Nicholas Darvis wrote, and then Steve came through and added his updated notes to it on every single chapter. And what year was this published? Jeez. The original was in the 50s. This is from 2012. So a couple books right there that I absolutely recommend everybody to get into are New Trader, Rich Trader, and How I Made $2 million in the stock market. So, Steve, if you don't mind, could you give us a little background on how you got into trading?
Yeah, it's really so natural. It all started, even as a teenager. I always loved business, first of all. I got to work in the mall when I was a kid and loved the business and thinking about, which was really all the P&Ls of all the businesses in the mall and how they operated and how sales flowed through a balance sheet. So really, it all started with like business, the love of business. So then I started realizing that those were publicly traded companies and I could invest in those businesses. So I thought, well, that's, fascinating. And then I started looking at, and I'm a teenager, we're talking 16, 17 years old. I started looking at the papers and looking at stock prices in the newspaper. Back we had paper newspapers, but some of the Zoomers won't even really see any of those. Uh, and then what was looking at business, entrepreneurship, capitalism. I got really passionate about all that because of the opportunity. I thought it was amazing in the 80s. I got to live through the mall era and got to be in all, be in the mall. And it was just, I loved everything about it. But it evolved into business, the publicly traded companies, and one of the big moments for me was a person, a insurance salesman came through. I think it was a whole life insurance salesman. Left a booklet where it showed compounding gains of a chart, and it was just an average. I don't know what it was, 8-10% gains on the investment inside of the whole life policy. And it showed the growth of capital with just the compounding. And that
Mm.
really got me thinking. I was like 17 years old. Thought, man, if I got some capital going at my age and just compounded it for year over year, I mean, this is astounding what I could have, in 10, 5, 10, 15 years. And so that really got me into building portfolio and when I was 18 and getting started and growing and trying to compound the gains and putting more money into it. And I really got started there, and then it evolved into investing, mutual funds. I got to have the benefit of the Nasdaq run in the '90s, which you think you're just a genius in the '90s, the way the Nasdaq just ran. Sort of like now, where you just get in, you hold, okay, everything's fine, you just keep on going, and you double down, and you get in, and I started out really with diversified tech funds, mutual funds, and I just had astounding returns on those. And then really my real education came in around March of I started getting more active with going in and out and selling into peaks and buying bottoms and like 99 and 2000 because the volatility started really picking up in 2000. And but I really learned some lessons from about March to 2000 on 2001, 9/11. I had about a 50% drawdown from peak, and that was after having just phenomenal double digit returns,
Mm.
20-30% returns during the tech era, which was pretty common. Even having more than that, some years were 40% returns. Even in like diversified tech mutual funds, which was crazy. It was even before the time of most ETFs back then. So, then when I started learning some lessons after 2001, 2002, I'm like, whoa, I don't want to ever take a 50% drawdown again like that. That really set me back on my compounding path. So then I started learning more about trend following and active position trading, and had another great run from 2003, about mid 2003 up until 2007. Had another phenomenal run, double digit returns, great years. And but then I was like, 2007 reminds me of now actually, where something just wasn't quite right. It was just too easy,
Mm.
much too easy, too long. And that time, like, I'm not taking a 50% drawdown again. So I started like preparing exit strategies, which I had some big positions in individual stocks and was just letting them run wild and make some phenomenal gains. But I was leery. But the for time I started getting leery around January of 2008, late 2007, I started seeing some problems. Early like January 2008, I was very leery, but they still went on. Started going mainly sideways, but then I was ready and started going to cash and staying in cash for all my biggest accounts during the 2008 meltdown. I was on the sidelines watching most of it. I did a little bit
Mm.
of day trading, dabbled in day trading for the first time, 2008, because the volatility was so crazy. But that really wasn't my thing. But I did avoid the drawdown from the 2008 massacre, and
Yeah.
just kept learning, going through each market phase and learning and growing. I think my best growth, I learned risk management 2001, 2002, and I learned the, the art of the exit, 2000, early 2008, and position trading during those years, 2003. I did heavy study. I read hundreds and hundreds and hundreds of trading books between 2002 to 2007, eight. I was reading a trading book every few days.
Mhm.
I could have probably read about 20 and spared myself about 400, but I did that and then came
I know
back and
exactly what you mean.
just kept
What are some
trading
of those
and
trading books that,
compounding and going full time and enjoying the game and it got to just wanting to share so much. Like my social media was like a stream of consciousness and just sharing what I learned and my real life lessons, my study of the legendary traders, the market wizards, the trend followers, and just sharing it. It's just really natural how everything evolved. I don't know if I could have stopped all this from the way it worked out if I tried.
hmm.
But yeah, that's the shortest version I can give you of that story.
Well, so what are some of those trading books that you would and wouldn't recommend? Yeah, I mean, you don't have to say the wouldn't recommends, but there was one that I read, and
Yeah, I would stick in the realm Yes, to stick in the realm of real trading stories like the Nicholas Darvises, the Jesse Livermore's, for the good and the bad lessons of those, and a lot of risk management lessons with Jesse Livermore. Plus, probably one of the greatest traders ever lived, which people have his story confused a lot. I think he just died, committed suicide. He had a lot of bipolar issues, and he also inflation adjusted, he probably made $1 billion
Yeah.
inflation adjusted during the Great Depression crash after going short over and over again. The Market Wizards, whole series of Market Wizards books. Jack Swager, one of the top. I mean, you can see every style of Market Wizards really helps you pick out the strategy that you want to use yourself. Covell's top tier trend following books goes down to all
Mhm.
the principles of trend following. You also got and the books written by the market wizards and the trend followers. You go down that path. That's a great path to go down. I'm more of the beginner's gateway to new traders. To start out at the very start where you can understand it. I'll give you like the comprehensive skills, help you build your vocabulary up early
Mhm.
and learn the very basics. So like I'm a stair step, and then you can grow into more complex books because that's the key is the comprehension. You have to. It's like learning another language. You have to build your comprehension skills so you even understand the more advanced trading books as you read them and understand the context. So, building
Uh,
up the skills of comprehension.
well, we'll probably be reading you in the next edition of Market Wizards out there, I'm sure.
I was almost John Boyk. I was almost in a John Boyk unknown traders. John Boyk has another.
You know
He's another
John Boy.
great one, great series of books. Yeah, but I was going to try to compile all my brokerage accounts, find them all. I had three different brokers, and I didn't save the paper account. Switch brokers. So I don't know. He didn't get the publishing deal with McGraw Hill, so I never had to go try
Mhm.
to locate him. So that's as close as I've come. But that was back then, and the size of my accounts was dramatically different over the years from when I started and from now. So it's fascinating how plus the size of the trading it counts a lot too for your success.
Right. So, um, I'll never forget when you and I were working together one day, and I was telling you about my particular style of trading at the time before I started making any actual money, and I was selling lots of calls, selling lots of puts, basically counter trend following by the absolute worst way possible. So when the market's going up, selling calls; when the market's going down, selling puts. And I remember you telling me one day, you're like, Chris, I used to trade that way, but then I realized that I wanted to make money. And there were a couple of times in my life that was one, and another one was when Minervini said, um, "That's why your trades suck, Chris." Like those two moments between you and Minervini were like, okay, I need to just shut up and I need to listen because these guys have made money, and me telling them what I am doing is not working, and I clearly don't need to be telling them anything, and I just need to shut up and listen. So I'm super stoked that you did take the time to work with me as well as work on all these trading books. I mean, I can't imagine how much time you've invested in all these.
It's such a actually, I started as a book reviewer because as I was reading, I read over 400 investing and trading books. I read over 1,000, like 1,300 nonfiction books, but it's like 400 plus investing, trading, finance books. And I was doing book reviews on Amazon. It was a way for me to, recapture and summarize and reinforce what I learned and the key principles. And I had those reviews I could refer back to. That's what I
Mhm.
started with, and that's where sort of I met all the other trading authors, and I ended up being at the peak somewhere, I don't know, was it 2008 or 9? I started 2005 reviewing the trading books. There's still like thousands of book reviews I've done online in Amazon. And I was the 154th most helpful Amazon reviewer on all of Amazon in
Wow.
all categories in like, I don't know, 2009, 2008 or so. So I had written, so and those are almost all trading books for the first 4 or 5 years and investing books. So I thought that, and then that sort of, it's like all that, it's like almost like it was all in me, and I had to like get it out and write it all down. And then my books actually helped me every time I wrote a book about any topic. It made me a better trader every single time. I'd come out of writing a book and I'd be better at what I did. What they say, if you want to learn something, deeper, teach it. So it
Yeah, I've
also
heard that.
reinforced
Yeah.
the writing the books helped reinforce after reading all the books, reviewing all the books, and then writing my own books. That was like how I educated myself.
hmm Well, talking about like New Trader, Rich Trader, what I really appreciate about that book in particular, and like I said, we've gone through every single chapter. And the funny part is, in fact, let me share my screen. The funny part about this is when I was going through it, I found my Kindle version, and I had all my notes in it from the first time I read it ages ago. And so I was going through and I was looking at all these highlights, like um, what have I learned since that point? And it was really cool to go back and do that. But there's a couple things that, or I wouldn't say a couple things, so much of what is discussed in this book that you wrote ages ago is still applicable and still the way that I personally trade today. Um, do you feel that you've had any personal changes in the way that you've been trading, maybe in the last couple of years or so versus the last decade? Has anything really changed?
Yeah, I try to make the book evergreen. So like they were principles. They were timeless evergreen principles. That was what I tried to design it to do, to be, a great classic trading book that could be read for my entire lifetime and never have to really update much of it. But yeah, I've evolved into more, because the trends have been so choppy lately. Uh,
Mhm.
it's hard to catch. I've really evolved more into a swing trade. I used to be a really longer term trend follower, and I mean, can slim like the buy the breakout of the growth stock like the Darvis. I mean, great success with that method for 2003, 2007. 90s were great. 2012 was a great year, but there's years where that stuff just is not functioning. I have other strategies. I have swing trading. I short. I used to not short very much. I quick got out of that habit, but then I started again shorting into these overbought crazy moves higher that I just think,
Mm.
when I think this is the stupidest thing I've ever seen, who in their right mind would buy this in this place? I've turned it into a short signal with, overbought reading. When it reverses and I see some distribution, I do go in and short. I have changed to some shorter term swing trading and tighten my time frame up a bit. And if a trend does work out again and something does have a signal and a breakout, I will still trade that way. But this just the market itself has become more erratic and more range bound more times, and the breakouts are so violent and sudden. And
Mm.
I've expanded my watch list to give myself more opportunities across more charts than just using the leading. I used to trade like the leading tech stocks and the indexes. So I have expanded my watch list to a lot of different dynamics. So expanded watch list, and I take a lot of shorter time frames than I used to take. And I capture less of the big trends because there's just less of them. I mean, every now and then you'll have some go nuts, but it's actually more rare now than it used to be.
Yeah. I've found that too, that my trading has been, I mean, I don't remember. It's been so long since I've had a trade on for more than 2 weeks, right? Just
Yeah.
something, put it
Yeah.
on, let it work for a few days and take it off
Yeah.
situation. It's just been ages since we've had really long runs. But if you don't mind, Steve, let me jump in and say hi to everybody. And then I
Yeah,
know
sure.
that probably going to get some questions and some feedback in the chat. So if you're watching this live, this is an opportunity to work directly with Steve right here. Feel free to ask any sort of question. I'm sure Steve is open to anything from trading basics to maybe something in one of his books, anything like that. We can put on the table. Just any way that we can help you out. So Michael Wales is here. Good to see you. He says, Buenos dias, amigos. Leo's here. Mahesh is here. Wes is here. Randy's here. We've got Michael from Germany here. Dave is here. We've got Tug. And then everybody tell me that I had my audio turned off, which I fixed. We've got Peter here. We've got Mikey Mike here. Sebastian also from Germany. Mikey Mike says the learning curve just continues to get steeper. He's new into trading, but um, you know, it's helping having Mikey Mike around because that he is new to trading. You've got to kind of like change the gears, right? Go back to the beginning. It's like, yeah, of course, it's so second nature to us now that we've been doing this for so long. But not everybody's, you and I, and had a chance to do this for ages. Um, Michael says the books are great. I've read quite a few of them, and they are so easy to digest. And you have taken a somewhat dry subject and made them engaging, double engaging, it seems like. Brian says, what was your most painful trade where you learned the most from, and what did you learn? Great question, Brian.
It's a really good question. I remember a morning where I took a momentum trade into strength. What was it? It's like two crazy wild stocks to, I remember what it was. It was like Priceline and Intuitive Surgical. I think just two high beta momentum volatile stocks, and they had a big surge up in the morning and a breakout. This was probably, gosh, 12, 12 more years ago. And I went in with Too Big. I just, was, back when I had, it took me a long time to get Trading Too Big out of my system because I had so much success for so long. It was just stupid. Especially, and so I went in way too big. I lost like $4,000 in like in the opening hour, and it was like supposed to be a long-term momentum breakout trade, and had to stop out of it that morning. I remember, I don't know why I remember that specific one. I've had bigger losses and more diverse losses and longer pain, different things. But that morning, just to lose $4,000 that quickly at that point in the game was just a chunk of money for my I was at my taxable trading account at the time. That was a lot of money. That was a lot of gains I gave back. That's one of the things that cured me of my trading so big. But trading so big is what got me a lot of my big early returns because that's one thing when you're trading. You're starting out, you're in $5,000, 10,000. I traded huge, 15, 20,000, 25. You keep growing your account, you're successful. But then when you get up 50,000, $100,000 accounts, you start trading bigger positions. It's funny how you have to scale yourself up mentally and emotionally to be able to handle it. Because like when I started out, like $5,000 was my trading account 30 years ago, and then like whatever it was, 15 years later, I lose $4 or $5,000 in one quick trade in 1 hour. But it's funny how you have to mentally spread. There's no way to just come and start trading, multiple six-figure account. You'd wet yourself. It would be too much. You have to scale yourself up to that size and get comfortable with it and have something that's not too volatile to cause you too much stress where you can't even follow your trading. Large
Yeah,
amounts
I
with smaller accounts was a one was painful on a percentage basis.
I was just telling somebody the other day that whenever you start trading, you really should start with as small as you can. Like $5,000 or less is a great place to start because then you don't come into it thinking, I've got this big bankroll. I don't care if I lose on a few. I've still got plenty of funds, right? If you come in at $5,000, you got to make those trades count. You got to actually work them, right? You got to really pay attention and figure out what you're doing. And then if you can scale a $5,000 account, you can scale a $500,000 account, right? But you can't start with a $500,000 account because mentally, well, you could
Mm,
if
yeah.
you want to have a lot less than that, but mentally, it's like coming in the casino with a big bankroll, right? Oh, I can lose a few trades, who cares? And then you don't have any risk management. But on the other end of it, you can learn so much more with that small pot of capital, and you can grow it so much bigger. Couple other questions are starting to roll through. We've got Jean Louis. He's here. Great to see you. Peter asks, what question should I absolutely ask Steve as a beginner trader? And what would be the answer? Oh, that okay. So he's asking you what question he should ask you, and what would be the answer?
That's a genius. That's a great way to use AI too. Asking AI how what you should ask it. You should ask like, what is the number one dynamic that makes you become a profitable trader? Like, what is that? What can it be reduced to? What is it? Psychology, risk management? What is it? And what it is a positive expectancy model that you trade with the right position sizing consistently. That is what creates a profitable trader, and that's a deep subject to learn. You can study a long time to find that. You want your system to have, whether you back test it, study charts, the way you manage your stop losses versus your trailing stops and profit targets. You want your system to have a positive expectancy that you will make money over a sequence of trades, but you have to execute those trades within the right position sizing dynamics where you don't risk ruin on a string of losses. Like whatever your win rate is, you can see what your probabilities of having a losing streak are, and you don't want to be trading so big that your first losing streak ruins you down to 50, 60, 70% drawdown or worse. And then you also want to have your positive expectancy system has to match your beliefs about the market, your available screen time, and your risk tolerance. And you can only do what you believe in, that you have time to execute. So you get that right, that is trading. And that is a lot to get right. You can spend time, but at least you stay on the right track and don't get off of that, going down rabbit holes that are silly. What stock should I pick? What stock do I buy? When should I sell this? I mean, that's like asking a doctor, like, hey, teach me about medicine real quickly. Hey, how do you have a quick surgery? How can I make some quick money in medicine? Like, you go to medical school. That's the first thing you do. So, I mean, I don't know. People think trading like a gambler when it's a business.
Yeah, good point. I mean, I think that really hit home during like the meme stock craze, right? When everybody got
Man,
their stimmy checks and they're like, oh, we got to buy AMC and GameStop and the weed stocks and everything else, right? And then all those people lost all of that and maybe even more, right? I heard so many horror stories of people who had a little bit of success in these meme stocks, and then they turn around, they borrow funds, they get it from their family, whatever, and then it's just gone. And so I think that risk management aspect is so crucially important. Let's see. Michael asked a question. I love moving averages 101. Just getting back to basic price action. In today's market environment, what are some moving average strategies you would consider as strong indicators?
My favorite has become the 5-day, 20-day exponential moving average for the speed and the change and the capture of a short-term swing. That is
The
really it's one of
crossover
the
of those
best.
two?
Yeah,
The
the
520 cross?
5-day, 20-day
Gotcha.
EMA. That's been my favorite crossover signal because of the time frame. Yeah, the 520 cross. My favorite strategy is a 5-day, 20-day EMA crossover on the daily chart, and then trying to hold it till it runs back to a resistance, whether it's a 70 RSI reading on the chart, a previous resistance, or previous price resistance zone. That is my favorite one. Even if, and I'm just looking for some momentum to catch a few day. If I catch, like Chris said, I catch 3, 4, 5 day move, 2 week move, I'm thrilled and
Mhm.
happy. And it's like it keeps you on the right side of that momentum. It takes a lot of momentum to get that five back over that 20 and to stay there. And it also
Yeah.
gives you, when it plunges, you have the 520 cross under. You stay out of it until the five crosses back over the 20. So you avoid the drawdowns and the plunges in meme stocks and things like that.
And that drawdown is such a big deal. And I tell people, like, you don't have to have giant drawdowns. You never have to have giant drawdowns. If you look at the chart and it goes under your moving average you're following, the math will tell you you're not going to have a giant drawdown. I mean, of course things gap down, but you're not going to lose 60, 70, 80% of your account by following the market and just like watching it implode on you, right? Um, let's see. Mahesh asked a question here. If you trade options, I don't know if you still do trade options. If you trade options, what's your preferred contract expiry date? Few weeks, few months? How do you decide?
Used to trade the weekly options about no more than 2 weeks out. When I first started, I tried to do a month and at times, but I evolved to about 2 weeks out. If I'm in the middle of a week, I'll do the next week's Friday expiration. I try to give myself, because my trading time frame, like Chris, same with Chris, about 2 weeks is my trading time frame most of the time. So I want to give myself 2 weeks for the trade to play out.
Mhm. That's awesome to hear, because my go-to is 21 days, and then I look to go maybe a week shorter, a week sooner, but 21 days is like where my starting point's at. So interesting you say that. I mean, Steve taught me everything I know, so it wouldn't be a surprise if all of our answers are the same. Uh, Brian says, "What would you tell 25-year-old Steve if you had 5 minutes to impart some wisdom?"
What would I tell? That's a very, very good question. It's a very good. I would probably tell the idiot to quit trading so damn big and making things so hard. That would be the first thing I was like, I'd probably tell him what I said before, like focus on to get I would teach him the trading system, the watch list, the signals. I would teach 25-year-old Steve Burns just a systematic process for trading, because that would have been, if I would have traded the way I do now back then, I would have been far more successful. Knowing what I know now, so I would have done this to watch. I would just train like all my e-courses and all the books. I would just gave them that knowledge. System development. This is your watch
Mm,
list. This is what you need to keep in and out of your watch list. Buy Bitcoin, buy Berkshire Hathaway and hold it, and just develop a systematic process, with the watch list and trading. I would have really trained him how to trade a systematic process with the right risk management that I knew would have fit me at that time, instead of
yeah.
trying to like be a just I don't know, young gun. I mean, I had the same thing in the 90s. I mean, just holding a lot of stuff. It reminds me a lot of stuff people do now with the whole thinking the buy and hold investor celebrating every all-time high, and uh and the thinking this could never go down, it could never crash, we can never have anything go sideways. I've lived through the 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 dot-com disaster in real time and the 2008 disaster in real time and saw it. And these
Mhm.
people are blind to the risks here.
Yeah.
And even to go back and study in the 1929 to 1953 market, where it was just sideways and you got dividends and you lost to inflation pressures. And like that probabilities are that's going to happen whenever this government spending ends. This party or the monetary policy has to go on higher interest rates to curb the hyperinflation that's going on. And so I would have, I think I got off track there, but no, I would have taught a trading system.
Gotcha. That makes sense. So we've only got about 5 more minutes, and then Steve said he's got to run. So let's continue those questions. These are awesome. Thank you guys for putting those in the chat. Mikey Mike says, Steve, of all your books, which 5 and in what order would you recommend reading? And he's already read New Trader, Rich Trader. So Steve, what are your top 5 books that you've written and what you feel is the best order?
It's a good one. New Trader, Rich Trader 1, New Trader, Rich Trader 2, New
Yep.
Trader 101 for to get the basics going. Moving averages 101, and then swing trading, the ultimate guide to swing trading. I think that would give a really good early foundation.
Perfect. Yeah. Peter says, that's a great question and such a valuable answer. Thank you, Steve. Mahesh asks, how much weightage do you personally give to insider trading from, let's say, company insiders or some big funds? How do you decode that information in your mind?
Insiders, I don't care about insiders selling. Usually insiders have lots of reasons for selling. They don't know when they got in to when they got out. Like insider selling is almost no waiting, because they probably just want the money, or they've been in so long it's time to take money off the table. Bezos got in at $1 or whatever, split adjusted. So Bezos sells, it means nothing because he's been in forever,
Mhm.
and he just needs to convert it to something else, diversify. So selling, nothing. Buying is a great bullish signal for if you want to do some fundamental dynamics. Insiders buying, they know a lot more than you know, and then on the blackout periods, and they're buying, they know that the business is doing good and their numbers going to be good, or they think they know. So it's a very bullish signal for insiders. Uh, for the institutional buying, I try to have only the stocks on my watch list that are being accumulated by institutions, and that's always been my play. You want to be the dips of the 50-day moving average, only work, if you have institutional support. A lot of institutions will acquire at the 50-day moving average, or, the 200-day moving average. They want to get in those dips, but you have to have institutional buyers to really hold those stocks up and buy those dips. Much
Mhm.
easier to trade when you have the support of insiders buying and you have institutional buying. They actually cause the massive uptrends and breakouts and trends are caused by institutional buying in most of the growth stocks, especially the tech stocks, the Max 7. So, yeah, those are two of the best bullish indicators, especially for watch list selection. You want to put things on your watch list based on, you can put things on watch list based on fundamentals, but then you want to trade them based on technical signals. So it's 2 steps to the process. So great way to acquire a watch list based on those factors.
How much or do you follow any sort of Congress trading, right? Are
Uh,
you following Nancy Pelosi's trades like you would an insider?
Yeah, that's another dangerous game to get involved in. But if somebody wanted to, I'm sure that's not my strategy or system. But yeah, that made a lot of people a lot of money, because I mean that has been a thing. The problem is, it's not real time. It's delayed reporting, just like with the 13 Fs with the mutual fund managers and the hedge fund managers. You're getting late information, so they could have got in before you did. I don't think it's
Right.
real. They have to report it. So by the time you report it, they could already be up 20, 30% ready to sell, and then you're just getting in. So I think that delayed information is not good.
Yeah, you become the exit liquidity at that point.
But yeah, you
Yeah.
don't know their entry or exit or timing.
Mikey Mike says this is awesome. And Steve, this has been awesome. I really appreciate you taking the time. I know you've got to run. So we'll go ahead and start wrapping it up here. But Steve, listen, it is great to catch up with you. I'd love to be able to chat with you again some more and learn more about what you're up to. But everybody, please be sure to go follow Steve, go buy all of Steve's books. Like I say, this one, New Trader, Rich Trader, one of my top 5. Another one that I would absolutely recommend picking up right away is How I Made $2 million in the Stock Market. And Steve was talking about earlier about how he loves the historical stories, like the real trader stories of the past. And this is an incredible story right here. And then you can see baby Steve on the back. Look, Steve, I told you, you haven't aged a day, dude. That was in 2012. So let's see. Let's catch up on the final bit of chat, and we'll drop Steve off. Thanks for coming on the live stream. It's really informative and fun to hear from someone who I follow on Twitter since 2019. Absolutely. Thanks,
Nice.
Wes, for that. Mahesh says thanks. Brian says, if you don't trust her, would you follow her trades? Bro, listen, I don't trust lots of people, but if they're going to make me some money, that sounds good to me. Leo says, thanks, Steve. Mikey says, thanks as well. And again, Steve, thank you so much for coming on today. Really appreciate you taking the time to do so. We'll let you drop off. I know you got to get busy.
Thanks, Chris. Great to talk to you again. It's been 5 or 6 years. It's crazy.
Dude, I know it's crazy. We're going to have to catch up again later. All right, Steve, have a great day, my friend. We'll talk soon.
Have a great one.
All right. Thank you all so much for coming to today's special live stream. Oh, my camera has shifted on me. I know that this has been a little bit different today. However, we want to start doing more of these trader interviews. So if you have some traders that you'd like to see, let us know over in the Discord. I'll do my very best to reach out to them and connect with them. Of course, I've got a pretty great network where a lot of the people that I've reached out to are friends of mine that I've had for ages. So really cool to be able to see Steve like that today. And again, if you haven't gotten Steve's books, he did mention his top 5 that he would say go grab, and absolutely would recommend all of those. I can't believe he's made so many books that he has completely lost track of them. I think that's hilarious. Let's see. Dave says thanks. Michael says thanks, and I want to say thank you for coming and watching live and participating. I know that you by coming, watching live with your questions, you made this better. So thank you so much for coming. We'll be back to our regular scheduled trading room tomorrow.